Hello all my dear students, I hope you all are doing good. So this is the third revision video which is in full English revision video. Keep it in your mind, all of you. This is a full English revision video of CA Final Direct Tax relevant for November 2022 exams. So this is for November 2022 exams. For May 23 and November 23 also I will put the full revision English videos. And for November 22 there are already two parts which are uploaded, which was on the chapter of business and profession. So we have done the chapter of business and profession in the earlier two videos. And now this is the third video where we are going to start with the discussion of return filing, assessment procedures, so on and so forth. Okay. So let us start the discussion of the revision video. And if you require the books of this revision video, obviously you would require books for the same. So if you require the books for the same, then definitely you can download the books from our website. That is aarishkhan.com. You can go to the free resources and you will get the colored summary book for November 2022 from there. Okay. So let us start with the discussion of the revision of the assessment procedure, return filing, so on and so forth, relevant for your November 2022 exams. Okay. So the first thing which you have to see over here is you should know that the relevant financial year, the relevant previous year which is applicable for your exams is previous year 21-22. Now, the first thing which the assessee will do is assessee will file returns under various sections, and returns are filed under various sections under income tax law. Let me tell you where all. It is filed under 139 subsection 1, 139 subsection 3, 139 subsection 4, 139 subsection 4A, 4B, 4C, 4D, 4E, 4F, 139 subsection 5, 139 subsection 9, 142 subsection 1 clause 1, and last but not least, return is filed in section 148. So these are the sections under which a return is filed. Once the assessee files the returns will go to Bengaluru. Once the return go to Bengaluru, the department can select some returns out of it for the purpose of what? Scrutiny. Government wants to check some of the returns in great detail, and for that purpose they will send a scrutiny notice to you. That is 143 subsection 2 is a scrutiny notice. The moment you get the scrutiny notice, that day is called as the commencement of the proceeding. You can say on that day the proceeding has commenced against you by the Department of Income Tax, and then the proceeding will go on for a few months, and then the AO, the assessing officer, will pass an order, and then that day will be considered as what? The completion of assessment. So this is what the assessment procedure is all about. You have to learn this particular concept in great detail in the subsequent revision videos, including today's lecture. Okay. Now, once the order is passed, if you're not satisfied with the order, then you have three options in life. First option, you can go for an appeal to CIT appeal. Second option, you can go for a rectification under 154. Third option, you can go for a revision under 264. You can go for either of them depending upon the facts and circumstances of every case. Okay. We will talk about them one by one whenever we will open these particular discussions. So today, the first thing which we want to revise today is 139.1. Let us talk about 139.1 today. All of you, pay attention please. All of you, fast. 139.1. This is what 139.1 is all about. This section talks about two aspects. First aspect, who is obligated to file return? Who is obligated to file income tax return? And once a person is obligated to file income tax return, what is the due date for the same? What is the due date for that particular person to file the ITR? Therefore, let us first of all find out the obligation. Who is obligated? Company and firm are always obligated, irrespective of the total income or loss. If a company is earning huge amount of money, they have to file the return. Even if they are into losses, they have to file the return. Return filing is inevitable for what? Company and firm. They have to always file the return. For others, apart from company and firm, who is obligated to file return? For others, like individual, HUF, AOP, BOI, for them, return filing is mandatory if their gross total income is greater than the basic exemption limit, and the gross total income which has to be seen is it has to be seen before two things. You have to add two things to your gross total income and then see whether it exceeds the basic exemption limit or not. Now, what are those two things? First is the deductions under Chapter 6A. You have to see the gross total income before the deductions under Chapter 6A. And secondly, you have to see the gross total income before the exemptions under the series of Section 54, which are applicable to capital gains assessee. Okay. So you have to see, this is an important point. You have to see gross total income before two things. Which two things? I have told you, before Chapter 6A and before exemption under 54 to 54GB. Now, there are some provisos which are added by Finance Act 2014 and Finance Act 2015. That is fourth proviso and fifth proviso. Now, this proviso mandates return to be filed by certain assessees. Now, who are those assessees? Listen carefully. If an assessee is RNOR, an individual, if an assessee is resident and ordinary resident and he is an individual and he is not obligated to file return in India, he is not obligated to file return by virtue of these provisions. He is not obligated because his income is lesser than the basic exemption limit. Still, the government of India says that he has to file the return if he has any asset located outside India or if he is a signing authority in any account located outside India. So, if a person who is an RNOR, an individual, who is not by default, he is not obligated to file the return. But if he has any asset located outside India, or if he is a signing authority in any account located outside India, then he has to file the return in India under the income tax law under section 139(1) as per the fourth and the fifth proviso to section 139(1). Okay. Now coming to the next one, that is I'll just come to this particular point after some time, because this talks about due dates, and once we complete the obligation, we'll come to due dates also. Now there are three more category of assessees for whom filing of return is mandatory. There are three more category. First, if a person has deposited 1 crore, more than 1 crore, listen carefully. If a person has deposited, this criteria is applicable to whom? Is it applicable to company? The answer is no. Companies are always liable to file ITR. Is it applicable to firm? The answer is no. Firm is always liable to file ITR. Then for whom this particular provision is applicable? This is applicable for other than company and firm. First, if he has deposited more than 1 crore rupees in a current account of a bank or cooperative bank, he has to file the return. Second, if he has incurred expenditure of more than 2 lakh rupees for himself or for any other person for a foreign travel, not travel in India, but for a foreign travel, for himself or even for any other person, if he is incurring more than 2 lakh rupees. Or third, if he is incurring more than 1 lakh rupees for the purpose of consumption of electricity, he is paying a bill of more than 1 lakh rupees for the electricity purpose, then he has to file the return. There are a few more categories which are added over here. Okay, through a latest circular issued by CBDT. I'll be discussing about that after some lectures. Don't worry about it. I've also uploaded a latest statutory updates lecture on my YouTube channel, but unfortunately that is in Hindi English mix. So if you try to understand, you can understand that. Anyways, I will be speaking in the later revision videos about those things. Okay. Now coming to the due dates. What are the due dates? There are three due dates under income tax law. One is October, one is November, and another is what? Another is July. Now who will file in November? November, transfer pricing assessees. Transfer pricing assessees will file in November. Now who will file in October? That is an important issue for us. Who will file in October? October. Company will always file in October. Always. Second, any other person apart from company like firm, AOP, BOI, individual, HUF, they will also file in October if they are liable for audit under any law. If they are liable for audit under income tax law, or even for liable to audit under any other law. If a person is liable for audit under any law, then that particular person has to file the return on 31st of October. Okay. So company to always 31st October. Company will always be 31st October. But other than company also can be 31st October if they are liable for audit under income tax law or any other law. It doesn't matter. Okay. Then a partner will also be liable to file the return on 31st October if the firm is liable to be audited. If the firm is getting audited, then the firm will file return on 31st October, and even the partner will file the return on what? The partner will also file the return on 31st October. This is what this provision has to say. Now there are some amendments made by Finance Act 2021. Now what are those amendments? Listen carefully. The first amendment is about with respect to this provision. Okay, pay attention please. That is, there is a partnership firm who is liable for transfer pricing. Now if a partnership firm is liable for transfer pricing, understand that the firm will file the return in November. Then how the hell the partner can file the return in July? Partner cannot file the return before the firm files, because partner will be getting the remuneration, interest, etc. from the partnership firm. Therefore, Finance Act 2021 made an amendment whereby it says that if a partnership firm has filed a return in November, that is, partnership firm is liable for transfer pricing, then even partners will be filing the return in what? In the month of what? In the month of November only, along with the firm. Okay. Second thing, there is one section 5A, which is applicable to certain states and union territories. Like it is section 5A, which is applicable to Goa, Diu and Daman, Dadra and Nagar Haveli. It is applicable to these states and union territories. Now, what is the provision in those states? There is a Portuguese law which is applicable in those states. And what does those Portuguese law says? Even today, that Portuguese law is applicable. And what does that Portuguese law says? That Portuguese law says that if a person who is a resident of these states or union territories, then entire income will be divided between husband and wife. Whatever husband earns will be divided between both of them. Whatever wife earns will be divided between both of them, except salary income. If salary is earned by husband, then it will entirely belong to husband. If salary is earned by wife, then it will be entirely belonging to the wife. But apart from that, a business income, an HP income, a capital gain income, another source income will be equally divided between husband and wife. So now there is an issue. Suppose there is a husband which is a partner in a partnership firm, and a partnership firm is liable for audit. So you all can say me, if a partnership firm is liable for audit and a husband is a partner of that particular firm, then and husband is a resident of Goa or Diu, Daman, Dadra and Nagar Haveli, so on and so forth. Then in that case, the partnership firm is filing the return in October, then the partner will also be filing the return in October. But whatever the partner earns on the partnership firm has to be equally divided between husband and wife. So if the husband is filing return in the month of October, how the hell the wife can file the return in the month of July? The wife also has to file the return in the month of what? In the month of October only. So in that case, I'm again give you an example. I am a resident of Goa and I have a partnership firm in which I am a partner. And that partnership firm is liable for audit. So the firm will file the return in October. I will also file the return in October because I am a partner, because partners whose firms are audited are liable to file the return in October. Similarly, my spouse will be getting 50% of my income, so she cannot file return before I file. So my return and my wife's return should go hand in hand. So in that case also, I'll be filing the return along with my wife, and my wife will also file the return in the month of what? October only. So this is what the amendment which has been made. Same amendment has been made here also. That there is a partnership firm who is subject to transfer pricing, and there is one partner, husband, is a part of that partnership firm. So if a firm is filing in November, then husband, who is a partner, will also file in November. What about the spouse of that particular partner who is residing in those states or union territories? Then in that case, that spouse will also file in the month of what? In the month of November. I hope it is clear to all of you. Okay, so this is what this provision is all about. Now, there are certain persons for whom the government has removed the obligation to file ITR. Now, who is that person? That is the person over here. Listen carefully, who is that person? Suppose there is a non-resident or foreign company. Non-resident or foreign company who has invested in what? In an investment fund, that is AIF. There is a non-resident outside India or a foreign company outside India who has invested in an AIF, and that AIF is located not in any part of this country, but that AIF is located in the IFSC. It is located in International Financial Service Center. Then the non-resident is not liable to file the return, subject to some conditions. First, that investment fund has deducted the TDS and has paid the TDS under Section 194 LBV, and that non-resident does not have any other income apart from whatever he earns from the investment fund. He should not have any other income. So if there is a non-resident or foreign company who is investing in an AIF which is located in IFSC, not in Mumbai, not in Chennai, not in Thiruvananthapuram, not in Hyderabad, not in Telangana, it is not located in these places. It is located in IFSC, and IFSC, where is it? It is in Gujarat. So it is located in Gujarat, in IFSC, and he is earning some income out of it, and TDS is deducted, and he doesn't earn any other income. Then he is not liable to file what? Income tax return under 139(1). Listen carefully, he is not liable to file the return under 139(1). But if the department wishes that he should file the return, then department can serve him a notice under 142(1) or 148, and 153 and 153C is removed now from Finance Act 2021. So I'm just striking that off. So, but if the department wants that that person should file the return, then the assessee has to file the return under the respective sections. Okay. Now, suppose there is a genuine reason, and there is genuine reason for delay in filing the return, then what will happen? Will the assessee be allowed to file the return? The answer is yes. This was held by a court in the case of Regan Powertech Private Limited, that if there is a genuine reason that the audit cannot be completed, the return cannot be filed, then it has to be condoned. A genuine delay has to be condoned by the department, and it has to be done. It is the right of the assessee that if genuinely he is not filing the return or not conducting the audit, and there is no mistake on the part of the assessee, there was a mistake on the part of the auditor. Auditor has done some mistake, and because of that, the assessee has to bear the burden of paying that extra fee, etc. In that case, the court has said that the assessee may or may not be liable for any kind of fee, and he will be allowed to file what? He will be allowed to file the income tax return. Okay. Now, what are the consequences? These are some of the consequences of not filing the return on time. One of the consequences is that you will not be allowed to carry forward and set off certain laws. Another consequence is you will be liable for interest under 234A and fee under 234F. Another consequence is you will be liable for best judgment assessment under income tax law if you do not file the return on time. Another consequence is that AO might issue a notice to you and require you to file the return under 142 subsection 1 clause 1. If you do not file the return on time, then the AO may issue you a notice requiring you to file the income tax return. Another is that you will not be allowed to get exemption under section 11 with respect to trust. You will not be allowed exemption with respect to political parties, etc. And last but not least, you will not be allowed the deduction of profit linked nature. Profit linked nature, which are those deductions? Like ATIA, ATIB, ATIC, ATID, ATIE, 10AA, etc. All these provisions, deductions will not be allowed to the assessee if the assessee does not file the return on time. What about ATC? Will the assessee get ATC deduction? ATC deduction is not a profit linked deduction. It is a payment linked deduction, and therefore that will be allowed to the assessee. What about ATD? ATD will be allowed because that is not profit linked, that is payment linked. What about ATG? ATG is again payment linked. It is not profit linked. Therefore, assessee will be allowed the deduction of ATG also. I hope it is clear to all of you. Okay. Next, ATAC. As I've told you, ATAC tells you what? No profit link deduction will be allowed to you. There are around 15 profit link deduction I've listed over here will not be allowed unless and until you file the return what? On time. If you fail to file the return on time, you will not get the deduction of profit link, but you can definitely get the deduction of what? Payment link, even by filing a late return. Okay. Next, what is the late filing fee? If you file the return after the due date, then it is 5,000 rupees. But if your total income is a very small assessee, you are a very small assessee, and if your total income is up to 5 lakh rupees, then in that case, you will be liable for fee of only 1,000 rupees. Okay. So generally it is 5,000. But if your total income is up to 5 lakh rupees, and if you do not file the return on time, then you have to pay the fee. You have to pay the fee of rupees 1,000 only. Okay. Next, returns by certain special assessee. Now these are special assessees covered under 139 4A, 4B, 4C, 4D, 4E, 4F. Okay. Now first special assessee 139 4A, charitable or religious trust. Now, when they are liable to file the return, if their total income before giving exemption is greater than basic exemption limit. Suppose if the total income of the charitable trust is 10 lakh and they get entire exemption of 10 lakh, then their net taxable income will become 0. Are they liable to file the return? The answer is yes, because what you have to see is before giving the exemption. If before giving the exemption, if the total income is greater than basic exemption limit, then the assessee is liable to file what? Liable to file the income tax return in this case. Okay. When they are liable to file, they are liable to file on October. These all assessees are special assessees. Their audit is mandatory, and because their audit is mandatory, they will be liable to file the return on 31st October only. If they do not file the return on time, then what are the consequences? There are two consequences which they have to bear. Normal assessees have to bear one consequence, that if a normal assessee does not file the return on time, then the normal assessee has to pay a fee under 234F. But here, the assessee has to pay a fee under 234F and also a penalty of ₹100 per day under 272A. Okay. Next is political party. Political party, if a political party is earning income, total income greater than basic exemption limit, and it is before giving the exemption. So if before giving the exemption, again the same logic, it is greater than basic exemption limit 31st October, only 234F, no penalty separately, unlike which is over here. Okay. Third, certain assessees whose income is exempt under section 10. Again, if before giving the exemption, income is greater than basic exemption limit, then you have to file the return on 31st October. And again, there are two kind of consequences which you have to bear. 234F fee you have to pay, and ₹100 per day penalty also you have to bear. Okay. Next, 139(4)(d). There are certain universities, colleges which are covered under PGBP. If you remember, Scientific Research Association, colleges, universities, statistical research, social science, they are also liable to file the return. Always, there is no threshold for them, and they always have to file the return by 31st October. In case they do not file, they will be liable to a fee under 234F. 139(4)(e) business trust. Business trust is always liable to file the return by 31st October. If they do not file the return on time, then 234F fee, that is 5,000, 1,000, whatever it is. Okay. Then investment fund, which is AIF, alternative investment fund, they are also liable to file the return always under income tax law by 31st October. In case they do not file the return on time, they will be liable to a fee of rupees what? Of 5,000 or 1,000 as the case may be. I hope it is clear to all of you till here. Okay. Now let us move on to the next section. 139(3). 139(3) talks about loss return. If you want to carry forward, carry forward a PGBP, business loss or capital loss, then you have to file the return on time. If you want to carry forward these losses and set off in subsequent years, then you have to file the return on time. Only these two losses. What about UID? For UID, there is no criteria to file the return on time. You can file a late return also. For house property loss, there is again no criteria to file the return on time. You can carry forward and set off the house property loss even by filing what? Even by filing a late return also. Suppose if I filed the return on time in the last year, and last year I have some loss, so I am carrying forward that loss because I have filed the return on time in the last year. So if I am carrying forward that loss in the current year, and if I am setting off that loss in the current year with some other income, will I be allowed to set off that loss if I file the return in the current year on if I file the return in the current year late? So last year I have filed the return on time. There is a loss which is getting carried forward from last year to current year, and in current year I am filing the return late. So will I be allowed to carry forward that loss and set off? The answer is yes, because in last year when the loss was incurred, in that year the return was filed on time. So what is important is the year in which you incur the loss, you have to file the return on time in that year. So in the next year when you set off, you may file the return on time, and even if you have not filed the return on time, still you can do what? You can set off that particular loss. Okay. Next, once I file the return, okay, then I will be allowed to carry forward. Suppose because of some genuine reason, I was not able to file the return on time. Okay. And there is a loss, PGBP loss, CG loss, or suppose for genuine reason, I was not able to file the return on time, and there is some refund in my case. And I come to know about that particular thing, say after 6 months, 1 year, 2 years. Will I be allowed to file the return? The answer is yes. Only in two cases. If there is a refund in your return, or if there is a loss in your return. If there is a payable, then there is no option. If there is a refund, if there is a loss in your return, then you can make a condonation application to CIT. If the loss or refund is up to 10 lakhs, then you can make an application to CIT. If the loss or refund is more than 10 lakhs, but up to 50 lakhs, then you can make an application to Chief CIT. If the loss is more than 50 lakhs or refund is more than 50 lakhs, then you can make an application directly to CBDT. Check here. So there are three authorities. Up to 10 lakhs, you have to make an application to CIT. Above 10 lakhs, up to 50 lakhs, then you have to make an application to Chief CIT. And above 50 lakhs, you have to make an application to what? CBDT. Okay. Now, once you do this, okay, then the question is, for how many years I can make an application? You can make an application for 6 years from the end of relevant AY. So whatever is the relevant AY, not PY, the relevant AY, say PY 21-22. AY 22-23, you can make an application 6 years from the end of 22-23 till 31st March 2029. You can make an application. It is allowed. After that, if you come, you will not be allowed to carry forward the loss. Okay. Next, if there is a refund, then will I get interest? Please spare me. Have some kind of mercy on me, on the department. Please don't ask for any kind of interest on refund. Okay. You will not get any kind of interest on refund. Okay. Let us move on to the next section. That is 139 subsection 4, belated return. If you do not file the return on time, then you have to file a belated return. By when? By 31st December. Or before completion of assessment, whichever is earlier. Now, which assessment we are talking about? There are two dates, whichever is earlier, by 31st December or before completion of assessment, whichever is earlier. Which assessment is getting completed even before filing the return? That is only one assessment is possible even before filing the return, and that is best judgment assessment. So your completion of assessment means best judgment assessment, and completion of assessment means date of passing the order by the assessing officer. The day on which the assessing officer will pass the order, you can say proudly that my assessment is completed. So by default, the date is 31st December. But if the AO completes the assessment before that, which assessment? Best judgment. And in that case, whichever is the earlier date. And what do you mean by completion of assessment? Date on which the AO passes the order. I hope it is clear to all of you. Next one. 139.5, revise return. By when I can revise the return? You can again revise the return by the same date. That is by 31st of December or before completion of assessment, whichever is earlier. If there is some wrong statement, some wrong information you have given, you can revise it. How many times I can revise? You can revise for n number of times. There is no time limit for number of times you can revise a return. Can I revise a return after getting a scrutiny notice? Yes, you can. You can revise the return at any time before completion of assessment. Getting a scrutiny notice does not mean that your assessment is completed. Getting a scrutiny notice means your assessment is going on. It is not completed. When is assessment completed? I have told you at the beginning of this session. Assessment gets completed on the date on which the AO passes the order. That is the date on which the assessment gets completed. I hope it is clear to all of you. Therefore, you can complete the assessment. Aram se, you have a lot of time. So till that time, the AO assessee can do what? Revise the return. Subject to 31st December. It cannot be beyond 31st December. I hope it is clear to all of you. Now, these are the few things which are there in section 139.5. 139.9. What is 139.9? It is talking about defective return. So there is some defect in your return. Then the AO will intimate you that this is the defect in your return. Please cure this defect. Then you have to cure the defect within the time of 15 days. AO will allow you 15 days. Here you are making a mistake, and who is identifying? The assessing officer is identifying that mistake. Then you have to rectify that mistake within 15 days. You can also ask for an extension. He will give you an extension. Okay. And if you do not revert back within the time, your return will be considered as an invalid return. It will be considered as an invalid return. Now, below that, there is a note. There are certain less important provisions about which I am not talking much. One is income tax return preparer. Now, I'll just tell you some important points out of it. Income tax return preparer can be only individual. It cannot be any person other than individual. Only individual can be income tax return preparer, and income tax return preparer can file return only for those assessees who are not liable for audit. Once an assessee is liable for audit, income tax return preparer cannot file return for such kind of big assessees. It means it is a facility made by the government of India whereby few small assessees return can be filed through certain small return preparers. Okay. Next, verification of income tax return. Verification means what? Who will sign the income tax return? Okay. Again, it's not an important thing for the exam. Don't worry about it. Okay. So now let us move on to something important. These are the things which are not much important. Don't focus much on this during the day of exam. Okay. It is not going to come in exam. Now, coming to the next topic, pay attention, please, all of you. Okay. Now, coming to this topic, that is assessment procedure. The first thing which is over here is 142 subsection 1 clause 1. Now, what is this particular section? This is a section where the department will send you a notice. Now, who will send me a notice? A notice will be sent by assessing officer, or it can also be sent by a certain prescribed income tax authority. It can be sent by assessing officer, or it can also be sent by a certain prescribed income tax authority. Now, who are those prescribed income tax authority? You can see over here, prescribed income tax authority shall be an income tax authority not below the rank of what? Income tax officer who has been authorized by CBDT. So it can be any income tax authority not below the rank of what? ITO. So now what is this notice all about? Pay attention, please, all of you. This notice is about if you do not file the return on time, then the AO may issue you a notice to file a return on time. So in how much time I have to file the return after I get the notice? That AO will mention in the notice. That AO might mention 10 days, 15 days, 20 days. You have to file the return within that time. Okay. Now, if I do not file the return on time, will I get a time to file a belated return? Not possible. If the AO tells you to file the return in 15 days, then you have to file the ITR within 15 days only. It cannot be belatedly filed. Secondly, once you have filed the return under this particular section, you cannot revise also, because it is not a revised return. It is not a normal return which can be revised. It is a special return under 142 1 subsection 1 clause 1. Therefore, this return cannot be belatedly filed. You have to file within the time allotted by the AO. Secondly, this return has to be once filed. It cannot be revised under section 139.5. It cannot be revised over there. Okay. Now, is it necessary to issue this notice to begin an assessment? The answer is no. This notice is not issued to begin an assessment. This is not to start an assessment. If you want to start a regular assessment, then you have to issue a notice under 143 subsection 2, which is a scrutiny notice. This notice is just to ensure that you file the return. This notice is just to remind you that you have not filed the return on time. So please file the return what? On time. This is what this notice is all about. Now, The second clause of this section, that is 142 subsection 1 clause 2. What does this clause has to say? This clause talks about certain preliminary inquiries from the assessee. The department wants to know certain information from you. Like, what does they want to know? They want to know the certain details from your accounts. They want to know certain information for which they are calling for certain documents. They want to know certain information. They want to know the statement of assets and liabilities at your end. So what are the assets which you hold today? What are the liabilities which you hold today? What are the bank statements in which you have got money? What are the accounts in which you have got money? Where the money has come from? Where the money has gone? This is just a preliminary inquiry. And if the AO wants to ask for an information for older than 3 years, he cannot ask for that. Here, the information only up to the last 3 years can be asked by the assessing officer. He cannot ask you the information older than 3 years from the assessee. Plus, this is just an inquiry to check the genuineness of the assessee. Whether this assessee is genuine or not, whether this assessee is showing proper income or not, he's keeping proper accounts or not, he's disclosing proper assets or not. This is just done to ensure that particularly. Let me tell you very clearly, keep both your ears open and listen carefully my words now, that by issue of this notice, that is 142 subsection 1 clause 2, AO cannot do assessment. AO cannot do assessment by issue of this notice. If the AO wishes to do an assessment, and there are 3 types of assessment under income tax law. First one is the regular assessment. If the AO wishes to do a regular assessment, then he has to send a scrutiny notice under 143(2). If an AO issues to do a best judgment assessment, then he has to issue a best judgment show cause notice under 144. And if an AO wishes to do 147 income escaping assessment, then he has to do 148 notice. So if he wishes to go for these assessments, then he has to mandatorily issue these notice. Otherwise, these assessments will be void ab initio. I hope it is clear to all of you. So this was some of the power of the assessing officer. Let us go ahead with the next power. The next one and the big one. The power of special audit. Suppose during the pendency of the proceeding, only during the pendency of the proceeding is pending, and at that time, the AO is of the opinion that, AO is making an opinion that the books of accounts are very complex. He is not able to understand anything. The books of accounts are very voluminous. He doubts about the correctness. There is multiple transactions in the book. The business of the assessee is very specialized nature. So in that case, when the assessment is going on, when the proceeding is going on, at the time of pendency of the proceeding, if the AO makes an opinion that these things are happening and it is in the interest of the income tax department, it is going to hurt the income tax department. It is going to give a loss to the income tax department if these assessees' books of accounts are not seen properly. So during the assessment, if the AO feels that during the pendency of the proceedings, if the AO is of the opinion that the books of accounts are complex, etc., and it is going to hurt the department, then he may direct the assessee to get the accounts audited, specially audited. And before giving direction, he has to give an opportunity of being heard to the assessee, which is the fundamental right of every citizen of this country. So he has to give a opportunity of being heard to the assessee. And after the opportunity is given, he may direct the assessee to get the accounts audited. And then the assessee will get the accounts audited. Now, who will search for the chartered accountant? Assessee will go to CIT. AO will direct assessee. Listen carefully the procedure. AO will direct assessee. Assessee will go to CIT and CIT will nominate a chartered accountant. Who will bear the expenses of the audit? That is the central government is going to bear the expenses of the audit. It is not the assessee is going to bear the expenses. Central government has to bear the expenses. Next, within how much time the assessee has to get the accounts audited? After I give him the opportunity of being heard, he is not able to explain me the things, then I will direct him to get the accounts audited. And after I direct him to get the accounts audited, I will mention in that direction that how many days he has to get the accounts audited. Suppose I can mention it at my discretion. Say I can give 60 days time, I can give 90 days time. It is not written in the law. Suppose I gave him 100 days time. So the assessee has to get the accounts audited within 100 days. If there is a requirement of extension, then I can suo motu increase the time. Even assessee can make a request to me that, sir, please increase the time limit. I cannot complete the audit within 100 days. Therefore, it can be further extended, but the original time plus extension, original plus extension cannot be more than 180 days. It cannot be more than 180 days. Suppose if I do not give an opportunity to the assessee, I am an AO and I have to give an opportunity to the assessee. If I do not give an opportunity to the assessee, what is the remedy assessee has? Assessee does not have any remedy under the income tax law. In such case, the assessee has to file a writ petition in the High Court. And the High Court will decide the matter. If in the High Court the assessee loses, then assessee can go to the Supreme Court also to file the special leave petition. Because there is no remedy under the income tax law against such particular thing. So if the AO gives a direction to the assessee without giving an opportunity, assessee will go to High Court and then Supreme Court. Okay. Now, everything is done. The report is ready. After the report is ready, the report is there in front of the assessing officer. And there are a lot of disallowances which could have happened. So now, before making those disallowances, the department says that you have to ask assessee once more and you have to give once more an opportunity of being heard that I am going to use this audit report to disallow your expenses. So the AO has to give assessee an opportunity of being heard. Always Not always. If the AO is doing a regular assessment, 143 subsection 3 regular assessment, opportunity of being heard has to be given. If the AO is not doing a regular assessment, but a dangerous one, the best judgment assessment, then the AO has to not give the opportunity of being heard to the assessee. Then no opportunity of being heard has to be given to the assessee. You can find it this over here. Everything which I am saying in the revision video, believe me, you will find it out in the book. Take a printout of this properly. Probably, if possible, take a color printout and do this book thoroughly. Once you do this book thoroughly, do the question bank, which I have uploaded on my website twice, and you'll be through. You'll be through. You can easily get an exemption in direct tax. And I don't think so there is any revision video on the entire YouTube which completes the entire syllabus in English. In Hindi, there are a lot of. Even my videos are there in Hindi. But in English, it is not there. I don't think so. It is completely available for November 22 exam. So make maximum use of it. And even if you are getting benefited 1% out of it, try to share it to maximum people around you. Please, in your southern part of India especially. That is in Tamil Nadu, in Kerala, in Andhra Pradesh, Telangana, and Karnataka. You try to spread out in these southern part of India as much as possible. You can do that much for the students community. Okay, that much favor you can do to others. Anyways, this is what this section is all about. Let us go ahead with the next one. That is 142A, valuation officer, reference to valuation officer. Suppose I am an assessing officer. I am doing an assessment. And I am finding it difficult to value certain assets, certain investments, certain stock. I am finding it difficult to get the fair market value. So the government has given the assessing officer a power that he can make a reference to the valuation officer. And he can make a reference to the valuation officer whether or not he doubts about the correctness of the books of accounts. Earlier, before Finance Act 2014, there was a condition that the AO can refer the matter to valuation officer only if he doubts about the correctness of the books. That is, if he doubts about the correctness of the books, he can make the reference. If he does not doubt about the correctness of the books, he will not make the reference to the valuation officer. But Finance Act 2014 has made an amendment around 8 years back, whereby the Finance Act 2014 says that AO need not identify whether he doubts about the correctness of the books of accounts or not. If he wishes to go to the valuation officer, he can always go for. And once he go for the valuation officer, what the valuation officer will do? First of all, valuation officer will ask the assessee. If the assessee is not replying, then the valuation officer will do the valuation as per the best of his judgments. Okay. And then the valuation officer will submit the report to AO as well as to the assessee. And what is the time limit? It has to be submitted within 6 months of the end of the month in which the reference was made by AO. Suppose if the reference is made by AO in July 2022, then the report has to be made within 6 months from the end of July, not from the date of reference, but from the end of July. Suppose the reference is made on 15th July, then it has to be made from 31st of July, not from 15th of July. Okay, because the law says from the end of the month. And then report will be given to assessing officer, and assessing officer will do what? Assessment based on that, after giving an opportunity of being heard to the assessee, obviously. Now, all these proceedings which we have learned just now, that is 142.1, notice issue, 142.2a, special audit, and 142a, that is what? Reference to valuation officer. All of them are going to be now a faceless proceeding. Faceless. Government is trying to make maximum proceedings what? Faceless under the income tax law, and government is making these proceedings also what? As a faceless proceeding. Okay. Let us move ahead towards the next section, and that is 143.1, which is an important one. What is this section all about? This section talks about scheme for processing of returns. This is a section where the returns, the crores of returns, the millions of returns which are getting filed are getting processed. Now, what is the procedure? The assessee will file the return either in 139 or 142.1. Then the return will go to the department. Department means where exactly? It goes to the Bengaluru department, Bengaluru. And there the return will be processed. And in the return processing system, there is a software which processes all the returns. In that, they will check two things. First, arithmetical error, if any. Second, an incorrect claim, if there is some incorrect claim. Now, you will ask, what do you mean by the term incorrect claim? The term incorrect claim includes three things, 1, 2, and 3. So, let us talk about one by one, all of them. Okay. So, the first thing which comes under the definition of incorrect claim is there is one item which is inconsistent with another item in the same return. Suppose there are some information which has to be put at two places. Same information has to be put at two places. So, at one place, you are putting something else, another place, you are putting something else, even though you have to put the same information at two places. The same thing, but you are putting different information. So, the return will pick up, the software will pick up that mistake and say that this item is inconsistent with another item. Okay. Next one. Suppose there is some information which is required to substantiate your claim. Suppose you have claimed a deduction under ATG, and in that case, you know that for claiming deduction under ATG, you need to put the PAN number of the donee. If you do not put the PAN number of the donee, then the system will pick up that error and will send you a notice that you have not put the donee's PAN number. So that is the information which is required to substantiate your entry. So the entry is what? Entry is your deduction under ATG, and you have to substantiate that entry. To substantiate that entry, you need to put the PAN of the donee, which you are not putting. So the software will pick up that mistake. And the third one is very simple. Your deduction, you are claiming certain deductions which is exceeding the statutory limits. Like you are claiming deduction under house property at not 30% but 40%. Like you are claiming deduction under ATC not at 1,50,000 but 1,80,000, 1,90,000, 2 lakh. So these are the mistakes which the software can pick up. Now, Finance Act 2016 has added few more mistakes which the software can identify. First, suppose if you have filed the return of last year late and there is a loss, then obviously you know that if you have filed the return of last year late and there is a loss, then you cannot carry forward that loss and set off. But instead of that, still you have carried forward and set off that loss. Then what will happen in the current year? The software will pick up that information, will add back your loss and will disallow that. Okay. Next, suppose there is a disallowance of an expenditure in tax audit, or there is an increase of income in the tax audit report. In the tax audit report, there is a disallowance which is reported by CA, or there is an income which is reported by CA, which you have not reflected in your ITR, So the software will match both of them and will add back the expenditure. Because in your tax audit report, that expenditure should have been disallowed, but in ITR, you have not done that. So the software will pick up and add back that. Next, there is any profit link deduction which you have claimed. I have told you today only that if you want to claim a profit link deduction, then you have to file the return on time. And if you have filed a return late and you have claimed a profit link deduction, nothing is going to happen. You are not going to get the deduction. The software will pick up that data and will add back that particular deduction. I hope it is clear to all of you. Now, before making an adjustment, they will send you a notice and they will give you 30 days time. You have to reply within 30 days. It's a kind of opportunity of being heard they are trying to give you. And if you do not reply within 30 days, then they will make the final intimation and send you. Next question. Is the intimation under 143(1) sent to all assessee? It is not sent to all assessee. The department is not obligated to send intimation to every person in this country. But in 3 cases, they are liable to send. First, if there is some payable which is found after making adjustment. Which adjustments? These adjustments. These are the adjustments which you have learned. After making these adjustments, there is some payable, or there is some refundable, or there is some increase or loss or decrease or loss. In these 3 cases, they are liable to send you intimation. Apart from this, they are not liable to send your intimation. Apart from this, your acknowledgement of return, which you have got while filing the return. Every assessee gets an acknowledgement while filing the return. So the acknowledgement which you have got while filing the return will be considered as what? As your deemed intimation. Now the question is, by when the department will send you the deemed intimation? Intimation or deemed intimation? The time limit is here. Earlier it was 12 months. Finance Act 2021 has reduced the time limit to 9 months. So the intimation has to be sent. It has to be sent by the department. Sending is important. The time limit is for sending. You may receive late. It's all fine. But department has to send on time. The intimation has to be sent within 9 months on the end of the financial year in which the return is made. In whichever financial year you file the return, say for previous year 21-22, you file the return in 22-23. Obviously, you will file the return in next year only. So department has to send the intimation within 9 months from the end of the financial year in which the return was filed. And the return was filed in 22-23. Obviously, you cannot file the return in the same year now. 21-22 return has to be filed in 22-23. So the intimation will be sent within 9 months from the end of March 2023. That is till 31st December 2023. I hope it is clear to all of you. Okay. If an assessee is not satisfied with the intimation, can an assessee file an appeal? Yes, it can file an appeal. Can an assessee go for a rectification? It can go for rectification. Can an assessee go for revisionary proceeding? Revisionary proceeding is not possible. For more information, see the chapter of appeal and revision later on. Okay. Now, can an assessee get an intimation? Can an assessee revise the return after getting the intimation? So you have filed the return has been processed. You have got the intimation. Can I revise after that? Yes, you can. Because revised return can be filed before the end of December or before completion of assessment. This is not assessment. This is just a processing of return. So once a return is processed, if I wish to again revise a return, can I revise it? The answer is yes, you can revise it. Okay. Now let us move on towards our first assessment. And for the first assessment, you have to send a scrutiny notice. And which is the first assessment? The first, I have told you there are 3 assessments. And the first out of it is the regular assessment. For regular assessment, the AO or the prescribed authority. Who is prescribed authority? Prescribed authority is Assistant Commissioner or Deputy Commissioner or AO have to serve a notice to the assessee. And what is the time limit to serve the notice? The time limit to serve the notice is within 3 months from the end of the financial year in which the return is filed. Suppose for previous year 21-22, if the return is filed in 22-23, then the notice has to be served within 3 months from the end of 22-23. That is, the return has to be served. Served means the assessee should now receive the return. In 143.1, it was sent. But in 143.2, it is not sent, it is served. It means their sending within time is enough. But here, the assessee should receive the notice within time. That is till which date? Till 30th June 2023. That is 22-23 within 3 months on the end of 22-23. That is till 30th June 2022-23. The assessee has to receive the return or receive the notice. Okay. Now, suppose if the assessee has received the notice late or if the assessee has received the notice in an improper manner, then what is the obligation of assessee? Then section 292BB comes into picture. If the assessee has received the notice late or if the assessee has received the notice in an improper manner, then it is the duty of the assessee to object that before the AO completes the assessment. If the assessee objects that before the AO completes the assessment, then the assessee is correct. then his assessment cannot be done. But if the assessee does not object till the passing of order, but he objects after the order is completed, after the assessment is completed, and now you start to object what? The validity of the notice, the properness of the notice, that the notice is not proper, the notice has not been served on time, then it is deemed to be valid. Then it is deemed to be served on time. Okay, keep this thing in your mind. Now there is one more angle over here. Suppose if the department has not sent you a notice and they have completed the assessment, then in that case there is no mistake on the part of assessee. In that case, the assessee can object even after completion of assessment. So if the AO has not sent you a notice only, there is a difference between sending a notice late, sending a notice in an improper manner, and not sending the notice only. In the first two cases, at least he is sending the notice. So in that case, you have to object before completion of assessment. After completion of assessment, if you object, then the notice is deemed to be valid. But if the AO has not sent you the notice only, and he tries to say that your assessment is completed, then the AO is always at fault. Then it is not the assessee's mistake. Assessee can raise objection even after completion of assessment. This is what this is given in section 143(2). Read with section 292 BB and along with the Supreme Court judgment of Lakshman Das Khandil. Okay. Next, is processing of return mandatory? Yes, it is always mandatory. It is always mandatory. It is mandatory for every person who files the return. Every person who files the return has to be processed. Has to be processed by the department. But in some cases, if the assessing officer has also given you a scrutiny notice and your assessment is also going on. So in that case, if your assessment is going on, what AO will do, if there is a doubt about recovering the revenue from assessee later on. Suppose in some cases what happens, suppose there is some assessee who has a bad record. He doesn't pay taxes on time. So in that case, what AO does, he processes the return, but he does not grant the refund. He does not grant refund. What he does, he holds the refund. By taking an approval from principal chief commissioner or commissioner, he will take an approval from them and he will hold the refund. And he will not give the refund now. He says that if I give the refund and later on while doing the assessment, if there is a liability which comes on the assessee, then the assessee will not pay. So I will withhold his refund. Till which date? Till completion of assessment. Once the assessment is completed, I will get to know the exact amount, and once the exact amount is known to the assessing officer, then he will do what? He will try to release the refund. Okay. Next, now we will start with the scrutiny assessment. Who will do the scrutiny assessment? That is regular assessment or scrutiny assessment. It is the assessing officer who has the right, who has the power to do the scrutiny assessment. Okay. Now listen carefully. To do a scrutiny assessment, that is under this section, the AO has to send a scrutiny notice under the previous section. That is 143(2). And to send a scrutiny notice, the assessee has to file a return. So these three links are one after another. To do assessment, notice has to be sent. Rather, notice has to be served because the word served is used over there. And to serve a notice, the assessee should have filed the return. Either under 139 or 142(1). Both will be fine. 139 will also be fine. 142(1) will also be fine. Once the assessee has issued the notice, once the AO has issued the notice to you, he will be calling you and he will be asking you for a lot of details. He will be asking for all relevant details, like he will be asking for ROI. He will be asking for a lot of things. He will gather through 143(2). Like he will be asking for what's a bank statement, etc. Then he will also get information from third party like special audit, valuation report, SFT, survey, summon, etc. Some of them you have seen, some of them you will see in the later topics. And after doing all those things, he will pass an order. And he will determine your total income, he will determine your tax payable or refundable as the case may be, and he will grant you the refund. If there is a refund, and if there is a payable, he will give you a notice of demand under 156, section 156, and you have to pay that demand within 30 days. You have to pay that demand within 30 days. Now, suppose the assessment is going on, and there is some deduction which assessee has failed to take earlier. Suppose assessee has failed to take a deduction under ATG. So can the assessee tell the AO that please give me this deduction by giving a letter, by requesting to the AO? The answer is no. The Supreme Court has held in the case of what? Go Ahead India Limited. Listen carefully. That if the assessee wants to claim a fresh claim, then he cannot give a plain letter to the officer. He has to file a revised return. File a revised return and make a claim. You cannot make a fresh claim to the AO and request him to give you a deduction based on your letter. It holds no validity under the income tax law. For that purpose, you have to file a revised return as it was held by Supreme Court in the case of what? In the case of Go Ahead India Limited. Now there are certain provisos which are attached over here. First proviso, second proviso. First proviso is for these assessees. See what I am underlining. Second proviso is for these scientific research assessees. Now, listen carefully what are these provisos all about. Now, first and the second proviso is somewhat similar. Now, what is this proviso all about? Pay attention, please, all of you. These are the assessees which are covered under 1021, 1022B, 1023A, etc., etc. Now, their income is exempt, subject to lot of conditions. And the conditions are given in central government notification. Now, AO, while doing the assessment, found that there are some conditions assessee is not fulfilling, subject to which exemption should be granted. But the assessee is violating certain conditions. So, what is the obligation of the assessing officer in such case? The obligation of the assessing officer in such case is not to disallow the exemption. But the obligation of the assessing officer in such case is to intimate that defect to the central government. And then central government will look into the matter, will cancel the registration of the assessee, will rescind the notification, and then will intimate the assessing officer. And then assessing officer will do what? Will disallow the exemption if there is a withdrawal of approval. Moral of the story, AO suo moto cannot disallow the exemption. He cannot do so. But under third proviso, the AO can disallow the exemption. He can disallow the exemption. Third proviso is for charitable or religious trust. For that, you need to understand the topic of charitable and religious trust. You have to revise that particular thing. So, the difference between first, second, and third. First and second, AO suo moto cannot disallow the exemption. He has to tell the central government, they will cancel the registration, they will intimate you, and then you can do what? Then you can disallow the exemption. But in third proviso, AO can suo moto disallow the exemption. Okay. This is the difference between first, second, and the third proviso. After this, let us come to the next assessment. That is best judgment assessment. There are 5 reasons why a best judgment assessment can be done. First, if the assessee does not file the return on time, a best judgment assessment can be done and the AO will issue you a show cause notice. Show cause notice tells that show me a cause why a assessment should not be done against you. A line like this will be written in the notice. Then you will be given an opportunity of being heard and then you can show your cause. Show cause notice means there is an opportunity which is given by department. So if you do not file the return on time, there is a show cause notice which can come to you that your assessment can be done in 142. If you do not comply with 142.1, there is no show cause notice will come to you. Direct assessment will be done. So in first case, if you make this mistake, there is a chance that you will get a show cause. But in second case, if you make this mistake, there is no chance that you will get a show cause. Direct assessment will be done, no show cause. Third case, if you do not comply with 142.2a, that is special audit. The AO has directed you to get the accounts audited, but you are not doing it. Again, he will send you a show cause. And then you have to reply. In fourth case, if you have not complied with 143.2, what is 143.2? That is scrutiny assessment. You have not complied with the scrutiny notice. AO again will issue you what? A show cause notice. So you can try to understand that out of these 4 defects, you will get a show cause here, you will get a show cause here, you will get a show cause here, you will not get a show cause here. Okay. There is one more reason why the AO might do a best judgment against you, and that is done in PGBP 145 subsection 3. If you violate subsection 1 of 145 and subsection 2 of 145, the AO may do a best judgment against you. What is 145 subsection 1? You have to follow cash or mercantile system, whichever is regularly followed by the assessee. You are not doing that. There is a danger of what? 144 against you. What is 145 subsection 2? 145 subsection 2 talks about, try to recall what does it talk about. It talks about if you follow mercantile system, then you have to follow the accounting standards given by the central government and which is ICDS. You have to follow ICDS as given by central government. Agar nahi follow karoge, if you do not follow, then in that case, AO might do a best judgment. This is the 5th reason why AO might do a best judgment for against you. So what are the reasons? 1, 2, 3, 4, 5, out of which this reason will not get what? A show cause also. Rest of them you will get a show cause. Even in this case, you will not get a show cause. Okay. Can I get a refund in 144? There is no possibility of refund under 144. 144 is not for the benefits of the assessee, it is for the benefits of the department. Okay. Then, can 144 assessment be a arbitrary assessment, random assessment? No, it has to be scientific and not ad hoc. The AO has to tell the assessee the reason why he has done the assessment like this. The AO has to tell the assessee why the assessment order contains this much total income and this much tax liability. The order passed by the AO has to be a speaking order. It cannot be an arbitrary order. It cannot be a random order. It has to be a very logical and scientific order. You cannot put random amount in the assessment order and say that you have to pay 5 crore tax, 10 crore tax. Because you have not filed the return, we will do anything. It is not like that. It has to be very logical. Okay. So this is what section 144 is all about. Let us talk about 144A, one last section of this particular topic, then we'll move on to the next topic. 144A, this is the power of JC. Now, while the assessment is pending, this power is only exercised when the assessment is pending. The JC has a power. Now, what is the power JC has? Suppose the assessment is pending. So, JC can suo moto interfere in the assessment and give direction to the AO that do assessment like this, like this, like this. These are the things you have to follow in the assessment. This is the first thing. Even assessee can make an application and tell JC that, sir, AO is not doing my assessment properly, please interfere. So, assessee can provoke the JC to get into the assessment. Third, even AO might go to JC and say that, sir, please help me in this part of the assessment, I am not able to do it. So, 3 people can initiate this proceeding. JC himself, assessee can make a request, even AO can make a request. In either of the case, whatever direction JC will give, assessing officer has to follow that. The order of the JC, the direction of the JC is binding on the assessing officer. It is not binding on the assessee. Then what assessee has to do? Whatever JC will say, AO will do. And after the AO has passed the assessment order, means he has completed the assessment, you can file an appeal against that to CIT appeal. You can check over here. Okay. Just go through it and then we'll move on to the next topic. Now let us go ahead with the next discussion. That is the next topic, and that is chapter number 14, which talks about income tax authority and their powers. So, first of all, we need to understand what do you mean by the term income tax authority, and then we need to understand one by one the powers which has been given to them by the government of India. So, the first thing which we need to understand over here is the income tax authority. As you can see over here, income tax authority is mentioned in section 116, which starts with CBDT, then Chief Commissioner, Principal Chief Commissioner, then Commissioner and Principal Commissioner. Besides that, there is a Commissioner of Income Tax Appeal also, who will handle appeal and other aspects. And then below the CIT, there are three authorities, that is JC, that is Joint Commissioner, Assistant Commissioner, Deputy Commissioner, and then Income Tax Officer. Now, the authorities mentioned in the box will be considered as what? Assessing officers under the income tax law. Whatever assessments are done under income tax law are done by these authorities, out of which JC is rank 1 assessing officer and rest of them are rank 2 and rank 3 assessing officer. Okay, so this is what income tax authority is all about. Coming to the first power of the income tax authority under section 131 subsection 1, this is the power to issue summon. So the department has the power to issue summon. Generally, the power to issue summon is with the courts, is with the civil courts. But under income tax law also, the government has been given the power under income tax law to issue summon in certain cases. Now, what are the cases under which the summon can be issued? First is if the department wants to discover or inspect something. So for the purpose of discovery and inspection, they can issue summon. Second, if they want to enforce attendance of any particular person, okay, say for the purpose of taking, examining an oath, etc., or for giving some kind of witness, etc. If the department wants to examine a person on oath, then they can enforce an attendance of that person. Third, department can send someone for the purpose of compelling you. Compelling means forcing you to produce your books of accounts and other documents. And fourth, department can give you summon so that they can issue a commission to you. What do you mean by issuing a commission? Generally, what happens that suppose if a matter is of Bombay High Court and the Bombay High Court wants a witness in the box and the witness stays in Delhi. So the Bombay High Court does not have a jurisdiction in Delhi jurisdiction. In Delhi, the jurisdiction is with the Delhi High Court. Bombay High Court directly cannot issue a summon to a Delhi person because Delhi person comes under the jurisdiction of Delhi High Court. So if the Bombay High Court want a witness in Bombay High Court to come and witness that particular incident, then in that case, if the person resides in Delhi, the Bombay High Court has to issue a commission to Delhi High Court. That process whereby Bombay High Court requests Delhi High Court that I want attendance of that person which is there in your jurisdiction. This entire process is called as what? Issuing commission. Now, these are the powers which are there under 131. Now, these powers are also there in the chapter of Board for Advanced Ruling. Even the Advanced Ruling Authority has been given the power to issue summon, and they also have also 4 similar powers. And this power is also there in paper 6. That is the black money law. Under the black money law, also the black money law authorities have this power. So, I am doing great amount of interlinking for you all. That is, I am not only interlinking this subject, one chapter with another chapter, but I am also trying to link this subject with another subject, that is paper 6. So this power is also there in what? In the chapter of black money law and also in the chapter of advanced ruling in this particular subject. Now, as it is mentioned over here, these powers are generally vested with the civil court. Generally, civil court have these powers, and these powers can be exercised even if the officer does not have any proceeding pending in front of him. Pendency of proceeding is not necessary to exercise these powers. It is absolutely not necessary. Okay, it can be exercised at any moment. Now, if the income tax authority wants some information from foreign authorities, there has to be a double taxation agreement between India and foreign authorities. So, if the income tax authority wants to issue a summon in foreign countries, not in India, but in foreign countries, there has to be a DTAA under section 90 or 90A. In that case, who will be the authority who will issue summon? So, the government has mentioned in 131 subsection 2, in that case, the authority cannot be lower than the authority of assistant commissioner. So, in that case, if the income tax authority wants to issue summon in international matter, then the authority should not be lower than what? An assistant commissioner of income tax. An assistant commissioner of income tax or above authority can exercise this power. Next one. Can income tax department impound your books of accounts? Impound means keeping in custody. The answer is yes, they can definitely impound your books of accounts. For how much time? They can keep as much time as they think fit. But the assessing officer or additional director or deputy director, again I am saying, income tax department can impound your books and keep the books with them as much time as they want. But if the authority is assessing officer, assistant director or deputy director, then they have to follow few things. That is, they can impound the books only after recording the reason. Without recording the reasons, they cannot impound the books. These authorities have to impound the book only after recording the reasons. And second, where they will record the reason? They will record the reason in higher authority under the income tax law. And secondly, once the reason is recorded, if they want to impound for more than 15 days, then they have to obtain an approval from chief CIT or CIT. So these authorities have been put under some kind of restriction. First restriction is, if they want to impound even for a day, they have to record a reason. And if they want to impound beyond 15 days, they also have to take an approval. Okay. Next power, section 133. This is the power to call for information. The income tax authority has the power to issue you a notice whereby they will call certain information from you. Now, who will have the power to? The power is given with assessing officer, CIT appeal, deputy commissioner appeal, and joint commissioner. These are the 4 authorities who have been given the power to issue a notice to call for certain information. Now, what kind of information they will ask for? And this notice will be served to whom? This notice can be served to a firm to furnish the details of all the partners. This notice can be served to a HUF to furnish the details of all the members and managers. This notice can be sent to trustees. It can be sent to guardian. It can be sent to agent and ask them, you are trustee in which all trust? You are agent for which all people? You are guardian for which all people? These are the information which they can ask for. This notice can be sent to any assessee who pays certain rent to someone. Suppose if I am paying some rent to my landlord, the department may send me a notice to call for information to whom all you pay rent, to whom all you pay interest, to whom all you pay commission, etc. So that the person to whom I pay rent, the person to whom I pay commission, the person to whom I pay, say, kind of interest, are those responsible person responsible enough to show their income under the income tax law? This is the kind of cross verification that the department is getting into. Point number 4, they can send a notice and call for information to any dealer, any broker, any agent, and ask them that who are the persons who are trading through your brokerage account, who are trading through your brokerage firm, who are purchasing and selling the shares and commodities through your broking firm. They can ask for the details. Means they can send notice to Zerodha. They can send notice to Ventura Securities. They can send notice to Sher Khan and ask for the information that who all are purchasing and selling the shares from your company. Last but not least, they can send a notice to any person, including a banking company, to give such information as which may be useful. So this is a general point which is covered in point number F. Now this proceeding is going to be now faceless under 135A. They are going to make this proceeding also faceless under income tax law. Now the next power, 133B. If the government, in the previous power, the government was asking and government was calling for the information from you. You are not giving the information. Now the government has the power to collect the information. So for collecting, what they will do? They will enter your any business place. They will enter your building place, any building or place during working hours only. Under this section, they cannot enter beyond working hours. And under this section, they will only enter your building or any place. They cannot enter vehicle, vessel, or they cannot enter your aircraft, etc. This power is given under search and seizure, which we will see later. This power is not over here. Okay, keep this thing in mind. So they will enter to collect certain. They are only coming over here to collect information. They are not coming over here to harass you. They are not coming over here to collect your assets. They are not coming over here to collect your books of accounts also. They are only coming to collect your information, certain information they want to collect. That's the reason they are coming over here. So where they are coming to your business place, your building, your place during working hours at business place, and they will ask the proprietor, employee or other person to help to give certain information. They will not take anything from here, as you can see over here. Next, 133C calls about what? This talks about the department has certain information within themselves. They have certain information with them, and they want to do what? If they have certain information with them, and they just want to verify that information, whether that information is correct or not. To just do that, they might do what? They might come call for certain information by prescribed authority. So in this section, the department has information. They just want to see the authenticity of that information, whether that information is genuine or whether that information is fake. For that purpose, they may issue a notice to you and you will be asked to answer a few questions and you have to answer them. Again, this process is faceless. This process is also going to be what? The faceless process. Now let's move on to the next one, and that it is a big one. It's a very big one and it's very important. Power of survey. The power of survey is given to certain income tax authority. Who are those income tax authority? These are the income tax authority, deputy director, and these are the authorities from whom they have to take an approval. And these are the income tax authority again, and these are the authorities from whom they have to take approval. So these are the authorities who will do actual survey, and these are the authorities who will be giving the approval for the survey. Okay. Now that is not a very important part. Let us move on to something important. Where the survey can be done. A survey can be done at any business place. It can even be done at charitable place now. Even charitable places are within the jurisdiction of survey, but religious places are not within the jurisdiction of survey. Income tax authority cannot do survey at a religious place, but it can do survey at charitable place and even business and profession place. When survey can be done? Survey can start. The department can enter the building or place or the charitable place only after sunset, but before sunrise. Only after sunrise, but before sunset. They will enter. They have to enter only after sunrise, but before sunset. So they cannot enter for a survey at 9 o'clock in the evening. They cannot enter for a survey at 11 o'clock in the night or 12 o'clock in the night or 3 o'clock in the night. They cannot do so. But there is one exception to that. If the business hours of the assessee is in the night, suppose the assessee is a call center. Therefore, the business hours of the assessee is 8 p.m. in the evening to 6 p.m. or 5 p.m. to 5 a.m. in the morning. So the business hours is 8 p.m. in the evening to 5 a.m. in the morning. So at that time, there is no sunrise. So in that case, there is an exception that they can enter the place and do the survey. Okay. Next, by default, they have to enter only after sunrise, but before sunset. So where they will enter? They will enter any business place, any profession place, any charitable activity place. where the books of accounts of the assessee are kept. Survey can be done even at home. It can be done even at home if the books of accounts are kept at home, otherwise not. If the books of accounts are kept at business place, then they have to do survey at business place. But if they go to business place and there is no books of accounts kept over there, books of accounts is kept at home, then they can go to home also. And what they will do over there by going for survey, after survey, what they will do exactly in the survey, they will ask the proprietor, they will ask the employee, they will ask any other person. What they will ask, that we want to inspect the books of accounts, please help. We want to check cash, please help. We want certain useful information from you, please help. A survey may also be done for checking TDS or TCS compliance. CBDT can do survey. Income tax authority can do survey just to check what? Whether the assessee is doing TDS and TCS compliance properly or not. What do you mean by TDS and TCS compliance? It means whether the assessee is deducting TDS properly or not, paying TDS properly or not, whether the assessee is filing quarterly return with respect to TDS or not. These are the aspects which the department can check and do survey. Also during the survey, the department has certain other powers, like they can place marks of identification, means they can put some marks and all that they have done some kind of survey in the books of accounts. They can also impound your books of accounts. They can retain and take the books of accounts. They can make a list of all the stock available with the assessee, all the cash available with the assessee, all the assets available with the assessee on the date of survey. They may also record a statement of the assessee or any other person that we have done survey, please give a statement, so that later on the assessee should not back out that there was no survey. There has to be a statement which is signed by the assessee which says that the survey was done on time. Can the department take anything from survey? Yes, they can take books of accounts, other documents. They cannot take cash, they cannot take stock, they cannot take valuable articles during survey also. All these powers are given under the great power of search and seizure and not under survey. Be very careful. Can survey be done in events, occasions, marriages, weddings? Yes, considering the nature and scale of expenditure. If the nature and the scale of expenditure is huge, then the department can also do survey in for the purpose of marriage, event, ceremony, functions, award functions, and so on and so forth, especially marriages and wedding ceremonies. They can do survey there also. There are many famous personalities, especially political parties, in whose case survey has been done. In what case? In the cases of wedding. Okay. And after that, if you don't cooperate in survey, you will be given a summon. And if you don't cooperate with summon also, you do not reply to summon also, you will be done what? There will be an authorization of search and seizure against you, and the department will do search and seizure. That is, they will do a raid against you. This is what this topic is all about. This section is all about. It's very important. 133A, survey, very important. Okay. Next power to inspect what? Registrar of companies. The AO, Joint Commissioner, CIT appeal, etc., or any person subordinate to him, they have the power to do what? To go to company law, and they can inspect any registrar of companies, debenture holders, or any other person, and they can also take copies for the same. So if they want certain details of the companies, of the investors, of the debenture holders, they can go to registrar of the companies and they can request them and they will give you the information. Okay, again this information is going to be faceless. Now survey cannot be faceless, obviously, for obvious reasons. Survey has to be done physically. It cannot be done faceless. How can I do survey faceless? Then it cannot be called a survey. I cannot do a survey online. I can call for information online. Okay, I cannot do a survey online. I can even this particular thing do online basis, but I cannot do survey online. Okay, please be careful about it. One last thing over here, 281B, provisional attachment. Now, provisional attachment, what is provisional attachment? What is attachment? Attachment means your property is attached by the department. Now, you can use the property, but you cannot sell it. You cannot sell that property now. So, when provisional attachment can be done? As per section 281B, provisional attachment can be done for two reasons. First, during the assessment proceeding, when the assessment is pending, provisional attachment can be done. So, the first time when provisional attachment can be done is during the assessment proceeding. Second, during only one penalty proceeding, not all. Assessment proceedings, all kind of assessment proceedings are covered over here, but penalty only one is covered. That is also amended by Finance Act 2021. During the penalty proceedings, which is covered under 271 AAD, we will talk about in the chapter penalty. During the penalty proceedings under section 271 AAD, where the aggregate penalty likely to be imposed is more than 2 crore. So only one penalty is covered, that is 271 AAD. That too, if the aggregate penalty is likely to be more than 2 crore. Otherwise, during penalty proceedings, you cannot do what? Provisional attachment. Who will do provisional attachment? AO will do. Why he will do? In the interest of the revenue. Will he take any approval? Yes, he has to take an approval from Chief Commissioner or Commissioner. And for how much time this provisional attachment is valid? This provisional attachment is valid for 6 months from the date on which the order was passed for the such attachment. So if I pass the order of attachment today, this will be valid for 6 months. After that, it will be what? It will be ceased to have effect. It will be ceased to be effective. Now, this provision of provisional attachment is also there in survey. It's also there in survey. So, it's also there in search and seizure. I have mentioned that below. You can see over here. So, it is also there in search and seizure. Even during search and seizure, if the department wants to do what? They wants to do provisional attachment, they can do so. In this section, when can you do? During assessment proceeding only. And during one penalty proceeding where the penalty is more than 2 crore rupees. But during search and seizure also, if the department wants to do some kind of provisional attachment, the department is free to do that. Okay, you can see over here, and then we move ahead. Now let's go on to the big one, that is the big power, that is search and seizure. This is the biggest power under the income tax law, apart from whatever we have learned so far. Okay, that's survey. Survey is a very small power in front of this. Let us talk about search and seizure. The first thing which we need to understand, who can conduct search and seizure, and the most important thing, who has the power to issue search warrant. So the first thing which we are learning over here, who has the power to issue search warrant. There are 8 authorities who have the power to issue search warrant, out of which 4 authorities have absolute power and 4 authorities have to take approval from CBDT. So the authorities who have absolute power, I am taking their name. Director General, Director, Chief Commissioner and Commissioner. These are the 4 authorities who have absolute power to issue search warrant. These are not the authorities who will do search. These are the authorities who will issue warrant for the purpose of search. Now there are 4 more authorities who have the power to issue warrant for the search, but they have to take approval from CBDT. Who are those 4 authorities? Additional Director, Additional Commissioner, Joint Director, Joint Commissioner. These are the 4 authorities who have to take an approval from CBDT for the purpose of issue of what? Search warrant. Okay. Now, why a search and seizure will be authorized? Why the department will do search and seizure against any person? Department will do search and seizure for any of the 3 reasons. If any of the 3 reasons are fulfilled, department feels that any of the 3 things are happening, they might do search and seizure against you. First, if the income tax authority on the information in their possession has reason to believe, these are technical words which you have to write in the exam. Income tax authority on the basis of information in their possession has reason to believe. You cannot replace the word reason to believe with any other thing. So if the income tax authority has reason to believe with the information in their possession, that point number A has happened. What is point number A? The assessee has failed to comply with 142(1) notice or 131 summon. He is not replying that. Second, he would not reply with 142(1) or 131. Department feels that he is a serial defaulter. Even if we send him a notice, he is not going to reply. He is going to fly out of country in some time. So it doesn't make sense to issue him a notice once again, because earlier also he has not complied. Again, he is not going to comply. Let us do search and seizure. Third, if the department has an information in their possession for which they have reason to believe that assessee has undisclosed income, undisclosed asset, undisclosed cash, undisclosed money, bullion, jewelry, undisclosed, not the disclosed one. If the assessee has undisclosed asset, undisclosed money, bullion, jewelry, the department can do what? Search and seizure. Now, for doing search and seizure, one of the primary conditions which the department has to fulfill, again I am saying they should have reason to believe. Reason to believe. They should have reason to believe. They should have hardcore proof. Then only they can do what? Search and seizure. So therefore the question arises, once the search is completed, everything is completed, can the department disclose that reason to any person? And the answer is no. They cannot disclose that to any person, any authority or tribunal. Check over here. They cannot disclose to any person, any authority or any tribunal. But can they disclose to High Court and Supreme Court? Yes. If the other party, that is the assessee, has filed a petition in the High Court or Supreme Court, then the department has to disclose that to what? The High Court and the Supreme Court, because disclosure to High Court and Supreme Court is not restricted by this particular provision which is mentioned over here. It is only restricted in case of any person, authority and up to appellate tribunal, not High Court and Supreme Court. It means one can file a petition in the High Court and the department has to disclose that to High Court or Supreme Court. Okay. Now, once the warrant has been issued, the power has been given to the officer, that is the assessing officer. Now, what kind of power he has? He has not a power. First power. Now he will be called as authorized officer. Now, what are the powers which has been given to him? Listen carefully. The first power which is given to him, he can enter and search now any building, any place, now even vehicle, even vessel, inner aircraft. Check, which was not given in survey, which was not given in 133 or 133B, etc. Now here all kind of powers are given. If the keys are not available, he can even break open the lock. And he can go inside and search any person. He can search any person who is about to come out of building. He can also search any person who is going inside the building. Then if your records are kept in electronic form, there is a password, etc. in your records, then the department will tell you to give that password and you have to give that password, or else you will be given a prosecution of 2 years for failure to comply with the department. There is a prosecution provision under 275B. Then after all these things, they will seize your books of accounts, documents, assets, etc. But they will not seize your stock in trade. Seizure of stock in trade is not allowed. Then they will do routine things which they have done in survey also, place marks of identification, etc., which was done in survey also. I hope you remember that. Okay. So these are the powers which are given to officer. Enter and search, break open the lock, search any person. Then tell any person to give you the what? The necessary electronic facilities, and then seize all the things except stock in trade. Okay. Now there is some CBDT press release with respect to gold jewelry. You can keep gold jewelry up to a certain limit without any explanation. Without an explanation. That is, for married lady, up to 500 grams, nobody is going to ask you any question. For unmarried lady, up to 250 grams, nobody is going to ask you any question. And for male member, it is 100 grams, whether it is married or unmarried, it doesn't matter. It is 100 grams. Nobody is going to ask you any question up to this limit. If you hold more than this, then they might ask you a question. That from where you have got this gold, from where you have got this jewelry. Secondly, above this limit also, if there is a custom and tradition to keep high gold in your family, then that is also allowed. Suppose Mukesh Ambani. For Mukesh Ambani, limit of 500 gram is nothing. So there is a custom and tradition of keeping more gold in their family. Suppose example, especially in Shetty families, there is a custom and tradition to give lot of gold in the marriage of daughters. So in that case, there is a custom and tradition. So the facts and circumstances says that even higher limit of gold can be ignored by the assessing officer. But this is the limit given by the law. And based on facts and circumstances, even a higher limit of gold, if it is there with the assessee and it is the customs and tradition of the family of the assessee, then that will also be ignored by the assessing officer. Okay. To what extent, that I don't know. 700 grams, 800 grams, 900 grams, 1000 grams, 2000. I don't know that. That depends upon facts and circumstances. That depends upon the financial worth of the assessee also. Okay. Now, deemed or constructive seizure. Now, what is deemed or constructive seizure? Suppose the assessing officer is not able to do the search and seizure because it is the thing which he is searching and seizing is very voluminous. Because the thing which he is seizing is having a lot of weight. Because the thing he is seizing is very dangerous in nature. And it is very having different kind of physical characteristic. Suppose the thing which he is seizing is bombs, explosive. The thing he is seizing is big cranes. So it is very difficult to do that. How will the department seize that particular thing? So in that case, the government has given a concept of deemed seizure, whereby the officer will give a notice to the person in charge, that is the assessee or any person in charge, and will tell that person in charge and assessee that do not use these things unless and until I tell you, and do not sell these things unless and until the officer gives you permission. And such seizure will be called as what? Deemed seizure or constructive seizure. And why it is done? It is done only in case where it is not practically possible to, because of the weight of the article, because of the volume of the article, because of the physical characteristic of the article. Okay. Again, deemed seizure concept is not applicable for what? Stock in trade. It is only applicable for other than stock in trade. Stock in trade is not possible to be seized. Even normal seizure is not possible of a stock in trade. Then forget about what? The deemed seizure of stock in trade. Okay. Then order of restraint. What is order of restraint? Order of restraint is not a seizure. If the department has a doubt, they are doing search and seizure, and there is some doubt that whether this property actually belongs to assessee or not. They are not sure also themselves. They are themselves not sure whether this property belongs to assessee or not. So in that case, the AO will not seize that particular property, will not seize that particular jewelry, bullion, cash, but he will give assessee an order of restraint and tell that please do not use this asset for 60 days. For how many days? For 60 days. And do not sell this asset for 60 days, and after 60 days you can do that. So they are putting some restriction for a period of 60 days in order of restraint. And this order of restraint is definitely not what? It is definitely not a seizure under the income tax law. Next, jurisdiction of CIT. Now this is a very interesting case. Suppose there is a property in Mumbai and there is a CIT in Mumbai. And the Mumbai CIT feels that in the property in Mumbai, there is some kind of asset which is kept. There is some money which is kept in Mumbai property. There is some jewelry which is kept in Mumbai property. But the problem which is coming over here is the property belongs to a person who resides in, say, Chennai. Suppose a property belongs to a person who resides in Chennai, then the Mumbai CIT cannot give the authorization for search and seizure. He has to take an approval from the Chennai or the CIT. Chennai CIT will give an approval to Mumbai CIT, and then he can do search and seizure in Mumbai. Because the property is the jurisdiction of Mumbai CIT, but the assessee is not in the jurisdiction of Mumbai CIT. The assessee is in the jurisdiction of what? Chennai CIT. So in that case, what will happen? Taking approval from the Chennai CIT might be detrimental to the interest of the revenue because there will be delay in that. And in the meanwhile, the assessee will try to remove his assets from Mumbai property. So in that case, the government has given an option to the CIT in Mumbai that he can directly do what? Search and seizure authorization. He may not ask to what? A Chennai property. If he has reason to believe that delay in getting the authorization from the Chennai CIT would lead to what? Would lead to detrimental to the interest of the revenue. So that delay would give an opportunity to the assessee to take the assets from the property immediately, or to remove the property from, to remove the cash, bullion, jewelry from the assets which is there in Mumbai. Because if you delay in doing a search, then some or the other way the assessee will come to know from his informers, etc. His informers are also there in the department, obviously. Anyways, can the department take the help of police? Yes, they can take the help of police. They can take the help of officer of central government. Okay, they can take the help of both also. They can do so while doing search and seizure. It can be fatal for their health also. So they don't want to take a risk. They can take support of these people. Okay. Now, AO may examine any person on oath, etc., etc. This is something which is very routine, which was there in what? Which was there in survey also. Now, next one is very important. What are the presumptions in the course of search? Very important question. What are the presumptions one has to make in the search and seizure? There are three presumptions which one has to make in search and seizure. Suppose if I am doing search and seizure, I am an officer, I am an authorized officer, I am doing search and seizure. There are three presumptions which I have to make. First, if I do search and seizure on any person and if I find something in the hands of any person, in the possession of any person, I have to make a presumption it belongs to such person. Second, if I see any content, if I see any books of accounts, documents, etc., and there is something written in that books of accounts, I have to believe that it is true. That is the basic presumption I have to make. And if I find any letter, any document in which there is something which is written which is signed, which is stamped, I have to believe that it is done by the person in whose possession it was found. Suppose that letter is in your possession and I find you and that letter is in your possession. So I will make a presumption that this letter is written by you, this letter is signed by you, this letter is stamped by you, this letter is executed by you. That's it. That is my first presumption. So the presumptions are very clear. If some assets are found in the possession of the assessee, it belongs to such a person. If some content is there in the documents, etc., assume it to be true. And if some documents are written, signed, executed, stamped by a person, then assume that it is done by the same person in whose possession it is found. Okay. Next, during the search, can the department value property? Yes, definitely. Department wants to quantify the wealth. They are doing search and seizure, and definitely while doing the search and seizure, they want to quantify the wealth. What kind of wealth? How much wealth is there with the assets? So the department can take the support of the valuation officer, which is mentioned in section 142A, and the valuation officer has to be slightly faster over here as compared to what he was doing over in 142A. In 142A, he was getting a time limit to 6 months to reply for that particular valuation. He was getting 6 months to make a report. Here, he has to make a report within 60 days. Check. Within 60 days, faster time limit is there here. He has to work faster as compared to what he will do in the normal assessment. Next one, provisional attachment. As I have told you in the previous topic also, can the department do a provisional attachment? Yes, they can do provisional attachment of your property during the search and seizure or within 60 days from the search and seizure. They can do during the search also, and even within 60 days from the date of search, they can do provisional attachment with an approval of principal director general, principal director general, principal director and director. And this will have an effect for what? How many months? That this will have an effect for 6 months. Okay, after 6 months, it will cease to be effective. I hope it is clear. I hope you guys are enjoying the lectures. Okay. Now let's move on to the next one, period of retention of books of accounts and other documents. Now, the books of accounts which is seized by the department during search and seizure, for how long they can keep it? They can keep it for 30 days after the assessment is completed. Now, please understand that after the search and seizure is completed, there will be an assessment which will be done with you under section 147. So once search and seizure is completed, there will be an assessment on you, which will be done after what? After the search is completed. So once the assessment is done, within 30 days after the completion of assessment, the AO has to return you the books of accounts. Now, can he keep beyond that also? Yes. Suppose if he wants to impose penalty proceedings after the assessment is completed, if he wishes to impose what penalty on the assessee, then he can take an approval from the higher authority, that is chief commissioner or commissioner, can retain the books of accounts beyond 30 days also. And once the penalty proceeding is completed, then after that, within 30 days, he has to return the books of accounts, etc. mandatorily. So by default, he can keep up to 30 days after the assessment is completed. Now, if he wants to impose penalty, then he can keep for further few months. And once the penalty proceeding is completed, then he has to return the books of accounts within 30 days after that. Okay. Now, in the meanwhile, if the assessee wants the copies, etc. of the books of accounts, he can tell the assessing officer, and assessing officer will give you the copy, etc. Okay. Now, next one, 132(9)(a). What does this provision talks about? Suppose there is an assessment, there is a search and seizure which is done on a person, which is say Mr. A. Suppose if the search and seizure is done on person, that is Mr. A, and at the premise of Mr. A, there is some property which is belonging to Mr. B, then what is the jurisdiction of my AO? The jurisdiction of the AO who is doing search and seizure of Mr. A will not do anything with that property. What is his duty? His duty is to collect that property, collect that money, bullion, and hand over to the relevant AO of Mr. B. So the officer only has to do one thing, that he has to hand over those things to the relevant AO of the relevant assessee. And what is the time limit to do that? And the time limit to do that is 60 days from the date the search is completed. So I am doing search on say Mr. A, and if I found property belonging to Mr. B, my duty is to give that property to the assessing officer of Mr. B within 60 days from the search is completed. Okay, next is section 132A, which talks about power for requisition books of accounts, etc. Suppose there is a person whose books of accounts, money, bullion, jewelry is already seized by certain other authorities, like it is already seized by ED, it is already seized by FEMA, it is already seized by say customs, it is already seized by say for example say GST law or excise law. Then in that case, what is the duty of the assessing officer? In that case, the higher authority, that is commissioner, etc., director general, etc., will tell the assessing officer that go and request the other authority to hand over those things to you. Obviously, income tax department cannot force the other authorities to hand over to themselves. They can only request the other authorities to hand over to themselves. So the director general, director, chief commissioner, commissioner will tell the assessing officer and will tell the assessing officer that go and request the other authorities, request ED, request CBI, request GST officers, request custom officer to hand over those things if it is no longer required for them. If it is no longer required for them, then please hand over to us, and then we can do our proceedings of search and seizure at our end. Okay. Now, last but not least, a very important provision of this chapter. Once the assets are seized, now how will what use the government will make of that asset? What all things will be recovered out of that asset? Suppose the government has seized a property of 7 crore rupees gold and 3 crore rupees cash. So the government has seized property of around 7 crore gold, 3 crore cash. Now what the government will do out of it? They will recover a lot of tax liabilities. First thing, they will recover your existing liability of income tax, existing liability of wealth tax also, and existing liability of gift tax also, if any. So out of the seized asset, the government will try to recover the following things: existing liability of income tax, wealth tax, and gift tax. Secondly, they will also recover now, after, as I've told you, after the search and seizure is completed, there will be a search and seizure assessment with you. There will be a separate assessment which will be going on against you. So whatever liability will come under that future assessment, that will also be recovered out of this particular seized asset only. So that is the main reason we have seized your assets, so that we will do an assessment on you and we will take liability out of it. Third, they will also take penalty and interest. Obviously, if there is any penalty and interest on the assessee, they will recover that also out of what? Out of seized assets. Fourth, the existing liability in point number 1 does not include your current year's income tax liability. If there is a current year income tax liability, department cannot recover that from what? Recover that from the seized asset. Okay. Now, this is a very important proviso which gives some kind of relief to the assessee, and it's very important for exams also. Pay attention, please. Suppose today there is a search which is happening, and the department is seizing certain assets and going and taking away in front of my eyes. I am not able to explain anything. So the department is giving me an opportunity of 30 days from the end of this month. So government says that we are seizing these assets. You have 30 days from the end of this month. That is from the end of the month in which the assets are seized. Suppose assets are seized on 15 July. Then you have 30 days from the end of July. That is still 30th August. You can come to us. You can come to the department and you can explain the nature and source. And we will return you your assets by taking the existing liability. We will not fully return. We will recover the existing liability and return you the remaining assets. Check. And within how many days they will return the remaining assets? Within 120 days from the completion of search, they will return your assets. So for that criteria, when you have to go? Within 30 days from the end of the month in which the search is completed. You have to explain the nature and source of that asset, from where you have got. Because on the day of search, you are very nervous, you are not able to explain on that day. So government is giving you an opportunity of 30 days after that. Okay. Then they are not going to fully return you. They will take the existing liability, if any, which will not include income tax or advance tax, obviously, because existing liability does not include advance tax. Existing liability includes old demands. Say there is some assessment which was done earlier for which demand was raised, you have not paid anything. There is some appeal which was done earlier for which some demand was raised, which you are not paying. That is existing liability. Okay. Now, how will the government recover your liabilities? Now, obviously, government is seizing two things: in non-monetary things and monetary things. So, government will recover their tax liability first from monetary things, and then if monetary thing is not sufficient, as in my example, the government was taking 7 crore jewelry and 3 crore cash. So, government will recover tax first out of cash. And if the cash portion is not sufficient, then the government will do what? Will sell your property and will do what? Will give you the balance amount of money after recovery of the tax. Okay. So, this is what this particular topic is all about. Now, let us move ahead towards a big one, and that is chapter number 16, and that is income escaping assessment. That is a big assessment. That is the third assessment of our life and the last assessment of your life after the regular assessment and after the best judgment assessment. Now, what will happen in this? Now, there are series of sections which you have to follow over here. That is from 147 to 153. 147 is complete only if you are done with 148, 149, 150, 151, 152, 152, and 153. You have to do these series of 7 sections, then only you are done with this particular topic. Now, what is the gist of this section? The gist of this section says that the AO will do assessment under this section. Again, the assessment is done by what? The assessment is done again by the assessing officer only. Now, why he will do a 147 assessment? Because he has an information which says that you have escaped assessment in earlier years. He has an information with him which says that there is an escapement of income in earlier years. Then he will do your assessment under 147. Subject to section 140 to 153. What do I mean by this? As I've told you, that this section is incomplete without 148 to 153. If you want to read this and if you want to understand this, if you want to apply practically and academically this section in your life, then you have to follow the provisions of 147, 148, 149 up to 153. So there is a lot of procedure which you have to follow. First thing which we need to understand is, what do you mean by escaped income? Income can escape because of whom? Income can escape because of assessee's default. Because assessee has not shown that income is in income tax return earlier, or he has not filed the return only. It can be called as income escapement. And in that case, 147 will be done against him. And in that case, he will be liable for tax, he will be liable for interest, he will be liable for penalty. Now, the second one is very critical. Income can also escape because of subsequent development in the law. Now, what is this? Let us try to understand and revise this. What do you mean by subsequent development in law? I'll give you an example. Suppose around 3 to 4 years back, there was an assessing officer who has allowed a deduction in my case. And now today, after 3-4 years, the Supreme Court in some other case has disallowed that expenditure. But in my case, 3-4 years back, the assessing officer has allowed that particular deduction. But in some other case today, Supreme Court came up with a judgment that this expenditure cannot be allowed as a deduction. So this is a subsequent development in law. This gives a power to my assessing officer to open my assessment of 4 years back and disallow my expenditure, because this judgment was not in the knowledge of officer 4 years back, and now this judgment is coming into the knowledge of the officer because of the subsequent development in the law. And subsequent development in law can happen because of the judgments of Supreme Court, or it can also happen because of retrospective amendment made by the law. So in case of subsequent development also, there can be income escaping assessment, but in that case, don't worry, you will not be charged with interest and penalty. You will be charged with tax only. You will not be liable to pay interest or penalty. Penalty is not impossible. Interest can be waived off. So you are liable to pay only tax. I hope you understood the concept of subsequent development in law. Earlier, an expenditure was disallowed because there was no judgment of Supreme Court to disallow that expenditure. So AO allowed that. So now in some other case, this expenditure is disallowed by Supreme Court. So in my case also, it can be disallowed by opening 147. Okay. Now for 147 to be applied, there has to be a procedure which has to be followed. What is the procedure? You have to follow 148, 148A, 148, 149, 150, etc., etc. So what is 148? 148 talks about serving a notice to the assessee, requiring him to file an ITR. So now the assessee will be liable to file an ITR under section 148. So let us try to understand this entire process. So AO is liable to send a notice to the assessee and tell the assessee that file ITR under 148 for say AY 1718, AY 1617, AY 1819. So assessee is liable to file what? ITR now. Once the assessee has filed the ITR, and then in that case the AO will start the assessment. So if the assessee has already filed ITR, is he liable to file again? Yes, he is liable to file again under 148. Within how many days he is liable to file the ITR? That will be mentioned in the notice, that within how many days the AO will tell the assessee to file the ITR. That will be mentioned in the notice itself. But before sending the notice for the purpose of ITR, before sending the notice under 148, the AO has to do some inquiry before sending that notice, which is done under section 148A in the next page. This inquiry is a kind of what? It is a kind of what? It is a kind of opportunity which is given to the assessee. So try to understand the steps. AO has some information in his possession that you have escaped income. So he has to send the notice to file, making you file an ITR. But before doing that also, he has to send one more notice to the assessee. That is a show cause notice. And asking the assessee to give an opportunity of being heard. That why 148 notice should not be sent against you. And if the assessee gives a positive reply, then leave the assessment there itself. And if the assessee gives a negative reply, and then go ahead with 148 notice. So you have to understand the steps. First step, the AO has information. Now what is the next step? He cannot directly issue notice under 148 to file return. First he will do inquiry on the next page. Once that inquiry is done, then he will send a notice under 148. Okay. So this is what the AO has to follow the procedure as. Now why the hell the AO will issue notice? Because he has some information. Listen this phrase carefully, which I am highlighting on the board. Because he has some information which suggests that income chargeable to tax has escaped assessment. So if the AO has information which suggests him, the information is suggesting him that assessee has income which is chargeable to tax assessment which is escaped, then only he will proceed ahead. So what do you mean by this phrase? What is the meaning of this entire phrase? The meaning of this entire phrase is defined by the CBDT in explanation 1 to section 148. And there are two things which is mentioned over here. First, if an information is flagged in the system of CBDT, generally it is flagged in SFT, Statement of Financial Transaction. You have done it in office, I guess. Or it is flagged in AIS, Annual Information System. You might have seen in office. So if an information is flagged in the system of the CBDT, then that can be considered as an information which can suggest the AO that income chargeable to tax has escaped assessment. Second, if any final objection is raised by Comptroller and Auditor General of India, if the Comptroller and Auditor General of India has done an audit and they have raised some final objection, that can be the basis for the assessing officer to do 147 against you. So these are the two reasons for which the AO can do what? 147 assessment against you. So again I am saying, first step, AO should have information which suggests that income chargeable to tax has escaped assessment. What do you mean by information which suggests that income chargeable to tax assessment? Either of the two things. Then AO will send an inquiry notice to you, will give an opportunity of being heard. How it is done, we'll see on the next page. Then if the result out of it is negative, assessee is not able to reply properly, then AO will send a notice under 148, requiring you to what? File an ITR. This is the procedure which you have to follow. Now, listen carefully. For the purpose of issuing this notice, the AO should have this particular thing. That is either this or either this. But there is an explanation too, which is an exception to this, which says that AO will always send you a notice for 3 years. 3 years. He will always send you a notice for 3 years in these cases. Always. Means in these 4 cases, there is no requirement for the AO. There is no requirement for the AO to satisfy himself about what? That the information chargeable to tax has escaped assessment. Please, it's a complicated issue. It's not that easy to understand. By default, if the AO wants to serve your notice, he need to have what? He need to have information which suggests that income chargeable to tax has escaped assessment, and which means what? Either it has to be flagged in SFT, or either it has to be flagged in Admin Information System, or either there has to be a final objection raised by CAG. But in these 4 cases, there is no need to do all those things. He can issue directly a notice for what? For 4 years. Whether inquiry under next section will be made or not, that I will tell you in a while. Which are those cases? If a search is initiated on or after 1st April 2021, if a search is initiated on or after 1st April 2021, he can directly issue notice under 148. If a survey is conducted on or after 1st April 2021, then he can directly issue notice under 148. He need not have to satisfy himself about these 2 conditions. He need not have to fulfill these 2 conditions. There is no need for a reflection in SFT. There is no need for what? There is no need for a final objection to be raised by CAG. In these cases, these are special cases. Except for these surveys. What are these surveys? 133, subsection 2A and subsection 5. Subsection 2A is the survey which is conducted with an intention of TDS and TCS. And subsection 5 is the survey which is conducted with an intention of checking the ceremonies, wedding, functions, etc. So those are not covered over here. For that purpose, you have to fulfill the above conditions. Third, the AO is satisfied that again it is a search case or search case. So in the case of search, let me tell you, if the search or survey is conducted, except the TDS survey, TCS survey and the wedding ceremony survey, if the search or seizure or survey is conducted on or after 1st April 2021, then you just make sure that 147 assessment is inevitable in your case. It will be 100% done. It will be 100% done. Whether the inquiry notice has to be sent or not, that we will see in next section, that is 148A. So once a survey is done, inevitable 147 assessment will be done. Once a search and seizure is done, inevitable 147 assessment will be done. Whether inquiry notice will be sent or not, that we will see now in this section. So before issuing a notice, as I have told you, the AO has to send you an inquiry notice. AO will send you a notice, will give you an opportunity, and you have to reply. You have to reply within how many days? The AO will give you a time limit of 7 to 30 days. 7 to 30 days, not less than 70 days, 7 days, but not less than 30 days also. Can it be extended? Yes, it can be extended. And after considering your reply, the AO will decide within 1 month. Here also it is 1 month, it's a mistake. Here also it is 1 month. So after your reply is considered, the AO will decide whether this is a fit case for 148 or not. And he will pass an order and decide whether should he go ahead or not. And if he goes ahead, then he has to send a notice under 148. And if he does not go ahead, he will close the matter there itself. What about if the assessee does not reply? If the assessee does not reply to the show cause notice, if the assessee does not reply to the opportunity of being heard, then the AO will definitely go ahead. There is no option available with the assessing officer in that case. Now, in the following cases, there is no need to do any kind of inquiry also. That is in the case of search, no need to do any inquiry. That is in the case of search, again search, no need to do any inquiry. That is in the case of search, again there is no need to do any inquiry. It means in case of survey, there is a need to inquiry, because on the previous page there were 4 cases in which there was no need to have any information. But in this page there are only 3 cases in which there is no need to have any inquiry. Therefore, for the purpose of search, there is no need to do any inquiry also. There is no need to have any satisfaction of information also. But in case of survey, there is need to do an inquiry, because not doing an inquiry does not have an exception over here. I hope it is clear. It's complicated. Therefore, I'll just conclude once again for last time for you all. AO should have information. Okay, that income chargeable to tax has escaped assessment. Now, what is his procedure? He has to first send you a notice under this section. That is 148A, give you an opportunity, blah, blah, blah. But in these 3 cases, there is no need to give an opportunity. But is it necessary to give an opportunity in case of survey? The answer is yes. Opportunity is mandatory in survey. Once this is done, he will go to the previous page and he will serve you notice under 148, requiring you to file an ITR. Now, in 4 cases, there is no need to satisfy himself about that information chargeable to tax as escaped assessment. 3 is search and 1 is survey. I hope it is clear to all of you. Now, after this, let us go ahead and find out what is the time limit by which the AO will issue notice. The AO will issue notice generally within 3 years from the end of the relevant AY. This is the time limit to issue notice. Suppose the income is escaped in 21-22. So the relevant AY is 22-23. So within 3 years from the end of 22-23 will come to 31st March 2026. So AO will send you a notice. This is the time limit to issue notice. The AO will issue notice. See here. The AO will issue notice within how much time? Within how much time? Within 3 years from the end of the relevant AY. But in certain special cases, it can be up to 10 years also. What are those cases? Beyond 3 years but up to 10 years. What are those cases? Those cases are where the AO has proved that assessee has escaped income of 50 lakhs or more. If the assessee has escaped income 50 lakhs or more, the AO has the power to send you a notice for more than 3 years but up to 10 years. Then in that case, for previous year 21-22, assessment year 22-23, he can send notice up to 31st March 2033. But he should have a reason to believe. He should have some kind of proof that income has escaped assessment and it is likely to escape of 50 lakh or more in each year. In whichever year it is 50 lakhs or more, which is escaped by assessee, in whichever year. For out of 7 years, out of 4th, 5th, 6th, 7th, 8th, 9th, 10th, out of 4th year to 10th year, any of the year, if the AO is having a proof that income escaped is 50 lakhs or more, he can issue notice for that year. And that income should be represented in the form of an asset with the assessee. What do you mean by the asset? That is also important. The income which is escaped in 4th year, 5th year, 6th year, 7th year, 8th year, 9th year, 10th year, first of all has to be 50 lakhs or more, and that should be represented in the form of asset. An asset is defined by the law. It can be represented in the form of land or building, or shares and securities, or loans or deposits, or advances, or deposits in bank account. That's it. This is an exhaustive list given by the law. Now, this is an amendment, as you all might be knowing, it is an amendment made by Finance Act 2021. If you have learned in class, whichever class you have learned from, if you have learned from me, I have obviously taught you in great detail. I have explained this particular topic for around 6 hours in class. So you just try to understand in what detail we have done this particular topic in class. Anyways, whether you have done it with me or with any professor, every professor would have taught you this particular thing and would have told you that this is an amendment made by Finance Act 2021. So the next part, which is over here, is not that important for exam, which says that this provision, the old provision, that is the old time limits, are also applicable. What used to happen earlier? Earlier there has to be separate assessment for income escaping and separate assessment for search and seizure. And for income escaping assessment, there was separate time limits of 4 years, 6 years, and 16 years. And for search and seizure, there was separate time limit of 6 years and 10 years. So the old time limits will also continue to apply if the matter is older. If the matter is older than 1st April 2021, the old time limits will also apply in the current year. But if the AO is issuing notice for financial year 21-22 or subsequent years, then only the new time limit will be applicable. So if the notice is issued for 15-16, the old time limit will also be applicable. But if the notice is issued for 21-22 or 22-23, the new time limit will only be applicable. Now, before issuing the notice, the AO has to take some sanction from the higher authorities. So who is the higher authority? If he wants to issue notice for 3 years or less, then he has to take approval from these authorities. And if he has to take, which are these authorities? Principal Chief Commissioner, Principal Director, Chief Commissioner, and Director of Income Tax. If he wants to issue notice for more than 3 years, but up to 10 years, then he has to take approval from slightly higher authorities. So these are slightly higher authorities as compared to what it is mentioned over here. It's not much important for exam. Okay. Now let's move ahead towards one very important case law of Supreme Court, that is Sun Engineering Limited. Now what is this case law all about? Let me tell you the facts. What has happened? The assessee has filed a return earlier. In the return, the AO has disallowed some expense of 15 lakh rupees. And listen carefully what this expense is all about. Even though this expenditure was allowed by Supreme Court in some other case. Now, if Supreme Court has already allowed this expense in some other case, why the hell the assessee has not appealed this particular case? Why the hell he has not filed a rectification application? But he failed to do so. So the AO added this 15 lakh rupees and made the assessment of how much? Assessment of 25 lakh rupees. Okay. Now pay attention, please, all of you. So earlier the assessee has declared an income of 30 lakhs or 20 lakhs. Then AO added unnecessarily 15 lakh rupees, which was allowed by Supreme Court. So my assessment is done at 35 lakhs. Now after a few years, AO found some escaped income. Okay. And he told me to file the return. So how I am filing the return? 35 lakhs already assessed. 25 lakhs newly found income. And then what I am trying to do is the expenditure which was wrongly disallowed earlier, I am trying to take deduction of that expenditure. So the question is, will I be allowed this deduction? The Supreme Court held in the case of Sun Engineering Limited that this will not be allowed. This will not be allowed. The expenditure which was allowed earlier, it cannot be knocked off against your escaped income unless both of them have some kind of what? Relationship. If this expenditure is related to this income, then it can be allowed. Then it can be allowed. But if this expenditure has no relationship with this, then it cannot be allowed as a deduction. Then it cannot be allowed as a deduction. This is something which is not allowed under income tax law because section 147 is not for the benefits of the assessee. The items which are concluded earlier cannot be reopened in 147. This is something which is concluded earlier. You should have appealed. You should have filed a rectification application. You should have filed a revision application. Why the hell you have not done that? You should have done that. So in case you have missed that, you cannot take that missed opportunity to be fulfilled over here. You cannot take an advantage of that missed opportunity over here. That is something which is not allowed. Then the government after this judgment came up with a section 152 subsection 2. What does it say? It says that if this amount, listen carefully please, if this amount is greater than this amount, if this amount is greater than this amount, it means your wrongly disallowed expenditure is greater than your escaped income, then you can tell the department to drop section 147 and the department will drop 147 because your escaped income is a smaller amount and disadvantages happened to earlier is a larger amount. For example, if this amount is 25 lakhs and if this amount is 35 lakhs, there is more wrong happened with you as compared to what wrong happened with department. What is wrong happened with department? 25 lakhs escaped income. What is wrong happened with you? 35 lakhs wrong disallowance. So in that case that you can tell department to drop that 147. But if this is greater than this, then 147 will be done and you will not get the deduction of 15 lakhs. This is what it says in section 142 subsection 2. Last but not least, what are the tax rates applicable for the earlier years for which the assessment is open? The tax rates applicable will be this year in which the income was assessed to tax. Suppose if you are opening assessment of 1718, then the tax rates will be applicable of 1718 only and not of today's tax rates. Okay, I hope it is clear to all of you. Go through it and then we'll move on to the next topic. So let's go ahead now to the next topic, and that is the first remedy under the income tax law. If you are not satisfied with the order of the assessing officer, or if you are not satisfied with the intimation made by the department, you have multiple remedies, and one of them is rectification of mistake. Now you will go under this remedy only if there is an apparent mistake. If there is an apparent mistake made by the income tax department, then you can go for rectification. If there is an apparent mistake made by the department itself, then the department also can go for what? Apparent mistake or rectification. So first thing which we need to understand over here, what kind of mistake which can be rectified over here. The mistake should be very apparent, which is very obvious. Some mistake which is very obvious will be called as apparent mistake. A debatable mistake cannot be called as an apparent mistake. A mistake, first of all, has to be very obvious mistake, which any two person in the world can vouch and say that yes, it is a mistake. Secondly, who will rectify the mistake? It is an income tax authority, any income tax authority. Whomsoever has passed an order will rectify its order. Like if AO has passed an order, AO can rectify. If CIT has passed an order, CIT can rectify. If CIT appeal has passed an order, CIT appeal can rectify, so on and so forth. Now, where is the mistake? The mistake is in the order, or it is in the intimation under 143(1) or TDS intimation or TCS intimation. So the department can rectify apparent mistake in any of the order, whether it is an assessment order, penalty order, rectification order, appeal order, revision order, any kind of order which is passed under this act. Department can rectify that particular order. But ITAT cannot rectify its apparent mistake under this section, because ITAT cannot be called as what? Income tax authority. So ITAT cannot rectify its mistake under section 154. But can ITAT rectify its mistake in some other section? Yes, it can rectify its mistake under section 254 subsection 2. Okay. Now, how is rectification conducted? Rectification is also conducted through a proceeding. Rectification in itself is a proceeding under income tax law, and which is completed by passing an order. So when a rectification order is passed, you can say that rectification proceeding is completed. The way assessment is a proceeding, appeal is a proceeding, the same way rectification is also a proceeding in itself. Okay. Now, if you're not satisfied with the rectification order, what you can do? You can go for again rectification. You can go for an appeal to CIT appeal, or you can go for a revision under 264. The way you can go for an assessment order, the way you challenge an assessment order, the same way you can challenge a rectification order as well. Now, suppose there is a Supreme Court judgment which is there. Can that be considered as a base to rectify my order? The answer is yes. Suppose in some other person's case, there is a Supreme Court judgment which says that this expenditure should be allowed. So can I say that my AO has made a mistake apparent from record? The answer is yes. A Supreme Court judgment in some other's case can become a base to rectify your order. Okay. Next, who can initiate rectification? A rectification can be initiated by the department suo motu, or it can be initiated by the assessee. Assessee can make an application, or it can also be initiated by AO, whereby the AO will go and tell to the CIT appeal, and the CIT appeal might rectify an order. So it can be initiated by department, it can be initiated by assessee, or it can be initiated by AO, where the matter has gone for appeal, and if the matter is in appeal, the AO can go and tell to the CIT appeal that please rectify this particular matter. In rectification, if the liability of the assessee increases, then you have to give an opportunity of being heard to the assessee. Okay. Next one, very important issue. What is the time limit to rectify an order? So if the department is suo motu rectifying the order, suo motu, as I have told you, department can suo motu also rectify, assessee can also make an application. If the department is suo motu making a rectification, then the rectification order has to be made within 4 years from the end of the financial year in which the order sought to be revised was rectified was passed. Suppose rectified order was passed in 22-23, then the rectified, suppose the order is passed in 22-23. Now you want to rectify this order, which is passed in 22-23, so it has to be passed within 4 years from the end of 22-23, that is till 31st March 2027. Secondly, if an assessee makes an application, then the department has to do slightly faster. That is within how much time? Within 6 months from the end of the month in which the application is received. So if the department is suo motu making a rectification, then it has to be made within 4 years from the end of the financial year. But if the assessee is making an application, then department has to react within 6 months. If they do not react within 6 months, then it can be considered that it is deemed to be in the favor of the assessee. Okay. The third question, what is the time limit to file a rectification application? So the law says that through its CBDT circular that you have to make a rectification application within 4 years. If you come for a rectification application after 4 years, then we will not accept it. You have to make a rectification application within 4 years. If you make within 4 years, the department might consider your application and will discharge your application in your favor. Okay. Now, suppose this is a very important case law of Hind Wire Industries Limited. Now, what is this case law all about? There was one assessment order in which there was 2 mistakes. Then the assessee make an application to rectify one of the mistake. The AO rectified the order and rectified one of the mistake. Then after a few years, the assessee made an application to rectify the second mistake which was there in the order. So the question is the time limit of 4 years. The time limit of 4 years to make an application will start from the second order or will start from the first order. The first order was the assessment order in which there was no mistake. The assessee made an application to rectify one of them, the AO rectified. Then the assessee made another application to rectify the second mistake in the assessment order. So the question is, the time limit of 4 years will be counted from the original order or from the revised order. So the Supreme Court in this landmark judgment has held that the time limit of 4 years will be counted from the rectified order, and the assessee will get 4 years from the rectified order to file another application and not from the original order. This is what it is given in this particular judgment. Okay. Then come one last concept, that is doctrine of partial merger. Now what is this concept all about? Suppose there is an assessment order in which there are a lot of matters, and if you have appealed certain matters, there is an assessment order in which there are a lot of things, and suppose if you have appealed some of the matters, then those matters, or you have gone for revision for some of the matters, then those matters cannot be covered under 154. Suppose there is an assessment order in which there are 10 items, out of which 2 are appealed by you. You have only appealed 2 out of it, 8 are not appealed. So those items which are already appealed in a higher authority or already filed a revision application, you cannot make a rectification for that particular 2 items. You can make rectification for the other 8 items. Okay. This is known as doctrine of partial merger, and it is very important, and it comes at 2 places under income tax law. Once in 154, once in 263 also later, and in one section under section 264, there is a concept of complete merger, doctrine of complete merger. Okay. Let's move ahead with the next topic, and that is a big one, that is appeal, revision, collection and recovery. These are the small aspects which are covered under one roof. So let us first talk about CIT appeal. So if the assessee is aggrieved by an order passed by an income tax authority below the rank of CIT, it means if the assessee is agreed with the order passed by the assessing officer, order under 143, 144, 147, or penalty order, or there can be any other order which is passed by AO. If the assessee is agreed, then the assessee has to file an appeal to CIT appeal. In form number 35, appeal has to be filed. The prescribed form is form 35. Within 30 days. Within 30 days from when? Within 30 days from the date of receipt of notice of demand. Can the department extend it? Department can extend it depending upon the facts and circumstances of every case. Then you also have to attach grounds of appeal. Apart from that, before filing an appeal, you also have to pre-deposit your tax. You have to pre-deposit your tax. Now, how much tax can be pre-deposited? The CBDT says that even if you deposit 20% of the tax as the pre-deposit tax, it is sufficient. You can deposit 20% tax and that will be sufficient compliance. Can I get a stay? If there is a genuine reason, you can make an application to the department and they can give you what? They can give you a kind of stay on payment of tax, and you can file an appeal without even paying 20% tax. Okay, by default, you have to pay 20% tax. But if you have financial hardship, you have financial genuine hardship, then in that case, you can make an application to CIT appeal and he might stay your payment of tax. Okay. Now, then your hearing will start. In hearing, the adjustments can be made. Adjustments can be made by what? It can be made by the assessee. It can be made by the CIT appeal also. It can be made by the assessing officer also. It can be made by either of the person. Now, during the hearing, what can happen? Now, during the hearing, now one more thing. Apart from the order, you can also appeal what? Intimations under income tax law. Even intimations are appealable. Intimations can be rectified also. Order can be rectified also under 154. Same way, intimation can be appealed also. Order can be appealed also under section 246A. Appeal is filed under section what? 246A. Now, during hearing, what can happen? There are 3 authorities which are sitting. Assessee is sitting here, AO is sitting here, CIT appeal is sitting here. Now, what will happen over here? There you can put forth certain additional grounds. Additional grounds means what? What do you mean by additional grounds? Appeal is going on. And you can tell the officer, that is CIT appeal, that I have not appealed on this aspect. Can I appeal on this aspect also? Suppose you have appealed on the aspect of depreciation earlier. Now you want to appeal on one more aspect. So that is known as additional grounds. So additional grounds can be accepted by CIT appeal if you can prove to the CIT that your omission earlier of this ground was not willful. I have not willfully omitted this earlier. I would have appealed this, but I was not able to appeal it. Or the omission was not unreasonable. This is what is written over here. Additional ground means a new subject matter. Can it be accepted by CIT appeal? Yes, if he is satisfied that omission was not willful or it was not unreasonable. Second thing which can happen during what? During the hearing, that is additional evidences. Now, what do I mean by additional evidence? Let us try to understand the meaning of this first. Additional evidence means an evidence which you were not able to put forth in front of the assessing officer earlier. So this is not a new ground. It is the same ground for which you were not able to put forth the evidences earlier. So now you can put forth the evidences in front of the assessing officer, in front of the CIT appeal as per rule 46A. So the difference between additional ground is a new matter only, which you have not appealed. So now you want to appeal that also. And what is additional evidence? An evidence which you were not able to give to the AO at the time of assessment. So now you want to give that evidence and make your case strong. So additional evidences can be given in 4 situations. First, where the AO has to admit the additional evidence. You were giving the additional evidence earlier, but he was not accepting. So now the CIT appeal will accept that evidence from you. Second, additional evidence will be accepted. Second case, Again, I am saying, listen carefully. What is additional evidence? An evidence which you are not able to put forth in front of the AO. So now you can put forth in front of CIT appeal and make your case strong. So in four situation you can do where AO has to admit. Suppose there was some CBT circular, AO was not accepting. So tell him don't accept. I will give in front of CIT appeal, then you have to accept it. First case. Second, suppose AO has passed an order without giving you sufficient opportunity. AO has asked for certain documents from you and you are not giving the documents. So you ask for certain 10 days time to the assessing officer. But assessing officer is saying that I am not giving you 10 days. And he passed the order. So that is wrong. That evidence you can put forth in front of what? In front of the CIT appeal. Third, suppose AO has asked for certain evidence from you. Okay. And you are not able to give that because you are prevented by sufficient cause. There was some genuine reason that you are not able to give. Example, your evidence says your documents, your books of accounts are already seized by the income excise department or FEMA or ED. So how the hell I can give the documents to the AO? I am prevented by sufficient cause. Don't worry. You can put forth in front of the CIT appeal. Or you are again prevented by sufficient cause for documents which were called by the AO. For example, your assessment was done under 144 without giving you an opportunity of being heard. Do you remember? In 144, there is one case. There are two cases, in fact, where there is no need to give an opportunity of being heard to do an assessment. Do you remember that? One is that case of 142 notice, and another is the case of 145 subsection 3, where you do not maintain your books of accounts on a regular basis, on a cash or mercantile basis. Do you remember that? In that case, the AO can do by judgment assessment without giving you a show cause notice. So the AO did the assessment without giving a show cause notice. And in that case, what has happened? What has happened in that case? In that case, the AO passed the order. Then you can go in front of the CIT appeal and you can do what? You can make an application of additional evidence. So these are the four situations which are extremely important for exam. You have to see them before the exams. Okay. Now, after all these things will happen, coming back to the first page, hearing is completed. During hearing, the CIT will accept additional grounds, may accept additional evidences also. And after that, CIT will pass an order. What is the time limit to pass an order? It is 1 year from the end of the financial year in which the appeal is filed. But this time limit is not mandatory time limit for CIT appeal. Let me tell you, it is a recommendatory time limit for CIT appeal. It is not a mandatory time limit. Please be careful about it. Okay. Next, what will be the scope of the order? CIT appeal can confirm the order of AO and say that whatever AO has said is correct. Or it can annul the order of AO. Annul means cancel the order of AO and say that the order passed by AO is wrong. Or it can also modify on higher side or lower side. If there is a modification on higher side, you have to pay demand. If there is a modification on the lower side, then you will get what? Refund. Okay. So this is what this first appeal is all about. This power is not there with CIT. You will understand this power after I explain the next appeal. Okay. So just wait for some time. You will understand this line after some time. Now let's move on to the second appeal, and this is the big one. This is the big one and a very important appeal. Appeal to tribunal. Now who can be aggrieved over here? Assessee can be aggrieved. Yes. Even the department can be aggrieved. Both of them can be aggrieved now with the order of the CIT appeal. So whomsoever is aggrieved, we will file form number 36 within 16 days. We'll pay the appeal fees, etc. Okay. Now after they also have to pre-deposit some tax before. If the assessee has to file an appeal to Atac, they also have to pre-deposit the tax. Okay. Now the person who has filed an appeal will be called as appellant, and the person who will be in the other side will be called as respondent. So the appellant will file an appeal to tribunal. Then what tribunal will do? Listen carefully. Tribunal will send a notice to the respondent and will tell the respondent to file a memorandum of cross objection within 30 days in form number 36A. So the appellant will file an appeal in form 36, and the respondent will file after the notice from tribunal a memorandum of cross objection under form number 36A. Okay. Both of them, both the time limit, that is this, the appeal filing time limit as well as the time limit to file memorandum of cross objection can be extended by tribunal. It can be extended. Now, during the hearing, can tribunal accept additional grounds? Yes, it may accept. During the hearing, can tribunal accept additional evidence? There is no specific provision over here, but it may accept. It may accept. Just like CIT appeal, it may accept additional grounds and additional evidences also. Okay. Now, tribunal will pass an order after that, after some time. What is the time limit to pass an order? I'll come to that in a while. What is the scope of the order of tribunal? Again, tribunal can confirm the order of the CIT appeal, or tribunal can modify the order of CIT appeal, or tribunal can annul, that is cancel the order of CIT appeal. And one fourth power is also there with the tribunal, and that is not there with CIT appeal. This power is there with tribunal. Tribunal can remand back the case to AO and will tell the AO assessing officer to do the assessment fresh. So this fourth power is not there with the CIT appeal. That is the reason we have divided the scope into two categories. This is disposal at the end of tribunal. Tribunal is closing the matter at his end, and this is something which the tribunal is remanding back. It is not ready to close the matter right now at his end. It is making the reference to again AO and telling the AO to do the assessment properly once again. Okay. So this is what this tribunal is all about. Now let us talk about a lot of small things in this particular section. Some of the things have been removed by ICI. So whatever is removed by ICI, I will let you know. Okay. Now, time limit to pass an order. What is the time limit? This is an important time limit. Very, very important. So listen carefully. What is the time limit to pass an order and granting of stay by ITAT? Listen carefully. It is slightly confusing. It is slightly tricky to understand. I guess this is the revision video and you all have learned all these things. You have come over here only to revise. Okay. Not to understand the concept, but I am trying to explain also in my revision video to the extent it is possible from my side. So it is my duty to all of you. One single request that if you are liking this video, try to share this video to maximum of your friends to the extent it is possible. Make sure that maximum people across the country, especially in the southern part of the country, takes an advantage of this video. It takes a lot of effort. It takes a lot of effort to make this video. It's not that easy. First of all, I am not generally used to speaking English. I don't know whether I'm speaking good English or not. I am generally used to speaking Hindi or partly in Hindi, partly in English. I don't know whether I'm speaking good English or not. I don't know, but I'm making a genuine effort for you all. So that I should not be biased only towards the North Indian students or to the western part of this country. I should try to do justice to all the students of this country, unfortunately, who is not able to understand Hindi properly, to them also, as you all are. Okay. So I'm giving my best effort for you all. So it is your duty that you just make sure that you share this particular thing to maximum people across country. And believe me, the content which I'm trying to give you within a short span of duration, just imagine what kind of content I might be giving in my regular batches. So that is the content we believe in CA final. One reason, there are two reasons for that. Direct tax is a very practical subject and therefore one has to do this subject practically. And for that you need to know the subject in depth. And secondly, the paper these days are coming extremely tricky. And for that you need to know an in-depth subject knowledge. Unless and until you are having an in-depth knowledge of the subject, you will not be able to crack a paper so easily in the exams. Either you will do wrong silly things or you will be leaving the paper of around 30 to 40 marks in the exams, then leaving no scope for you to score exemption in the paper. Therefore, I sincerely request you all that see this video again and again, again and again, again and again. Believe me, see this video again and again and solve my question bank. That's it. You will be through. See this video again and again. Apart from the rest of the videos which I have uploaded or I will be uploading, I will try to upload as fast as possible the entire syllabus for you all, the way I have done it in Hindi. But it is your duty to make maximum out of it. Okay. Anyways, what is the time limit to pass an order? The time limit to pass an order by ITAT is 4 years from the end of the financial year in which the appeal is filed. Suppose if I file an appeal today, then from the end of this financial year, the tribunal will pass an order maximum within 4 years. Okay. But can tribunal grant you stay? Yes, tribunal can grant you stay over here from pre-deposit of tax. You have to pre-deposit tax before making an appeal. But tribunal has been given the power to grant a stay to you. Okay. Now listen carefully. Here there is some kind of confusion which can create. So the government says that if the tribunal is granting you stay from payment of tax, then the tribunal should make sure that it should pass an order within 180 days. Very fast. If the tribunal is granting you stay, then it should pass an order within 180 days. Plus tribunal should only grant you order if the assessee pays. Listen carefully. At least 20% of the tax or equivalent amount of security. Listen carefully. By default, tribunal has to pass an order within 4 years. But if there is a stay which is granted by tribunal, tribunal can grant stay, provided assessee has to pay at least 20% tax or equivalent amount of furnished, equivalent amount of bank guarantee of security. Then the tribunal can grant stay also. And in that case, the tribunal has to pass an order within 180 days. It has to pass an order within 180 days. Can that 180 days be extended? Yes. If the delay is not attributable to the assessee, if the delay is attributable to the tribunal, it can be extended to 365 days also. It means by default, if there is a stay granted by tribunal, the stay will vacate after 180 days. But an order should also be passed within 180 days. The appeal should be completed. Can that be extended? Yes, it can be extended if the delay is not because of assessee. It means if the delay is because of tribunal was not able to function. Can it be extended from 180 days beyond that? Yes. If the delay is attributable to tribunal, it can be extended to 365 days also. But if the delay is attributable to assessee, it cannot be extended beyond 180 days. Assessee was not able to attend the appeal. So the delay is attributable to assessee. In that case, it cannot be extended beyond 180 days. But assessee was completely cooperating. Tribunal was not having time. So in that case, the delay can be extended up to what? The stay period and the appeal period can be extended up to 365 days. Okay. Can that be extended beyond 365 days? The law says no. But there is a Supreme Court judgment, which you will learn later on in the case law book. That very recent Supreme Court judgment, that the tribunal has to extend beyond 365 days also, if the delay is not attributable to the assessee. What is the mistake of the assessee if the assessee is cooperating and the tribunal does not have time? So moral of the story is very simple. First of all, 180 days. If the assessee is making the delay, then matter is closed. It has to be closed within 180 days. But if the assessee is not making the delay, tribunal is making the delay, it has to be extended up to 365 days. It can be extended beyond 365 days also, as per the Supreme Court judgment of Pepsi Foods Limited, I guess. Okay, I hope it is clear to all of you. Next. Now there are a lot of issues, one issues we are going to address. First issue. Tribunal has the power to remand back the case to AO, as I have told you. You can see over here, right? So, can the AO pick up new matters which are not remanded back? Suppose tribunal has remanded back the case to AO by saying that please check depreciation properly and make a fresh assessment. So can the AO look into other matters also which are not directed by tribunal? And the answer is no. He cannot get into other matters. Second, suppose the tribunal has remanded back the case to the AO for previous year 21-22 because the appeal was filed for 21-22. So tribunal has remanded back the case to the AO for previous year 21-22. Can the AO reopen the matter for 18-19, 17-18, 19-20, 20-21? The answer is no. The AO has to only open the matter with respect to the year in which the tribunal has remanded back. It cannot reopen for other years. Nor the tribunal can direct for other years. The tribunal cannot direct the matter for other years. If the appeal in the front of tribunal is for 21-22, the tribunal can refer back the matter to AO only for 21-22 and not for other years. Okay. Third. After the ITAT has passed an order, can ITAT review its own order? Review means taking second view. Can ITAT take a second view after it passed an order? The answer is no. Review is not possible. But can ITAT rectify a mistake apparent from record? The answer is yes, but not under section 154 because under 154, as I have told you sometime before, under 154 only an order of income tax authority can be rectified. ITAT is not an income tax authority. Therefore, there is a special section over here, section 254 subsection 2, which says that the ITAT can rectify its order under section 254 if there is a mistake apparent from record. The ITAT cannot change its opinion. It cannot review its own order and change the order. It can only rectify if there is an apparent mistake. What is the time limit? 6 months. It has to be rectified within 6 months. If the ITAT is suo motu rectifying within 6 months, if the assessee is making an application, then also within 6 months. Okay. So here there is one Supreme Court judgment which says that can High Court review its own order? So it was held by Supreme Court in the case of Meghalaya Steels Limited that High Court has the power to review its own order, but the ITAT does not have the power to review its own order. So listen carefully. Can ITAT review its own order? The answer is no. Can ITAT rectify apparent mistake? The answer is yes. Can High Court review its own order? The answer is yes, as per this judgment. Okay. Next, there are how many members in ITAT? Then how many judges in ITAT? Generally, there are 2 judges. One is judicial member, one is accountant. Judicial member is a lawyer, accountant member is chartered accountant. But if the assessee's total income is up to 50 lakhs, then there will be only one judge, that is judicial member. So if the matter is up to 50 lakhs, there is only single bench judge. If the matter is more than 50 lakhs, then there will be 2 bench judge. Okay. Next. What will happen since there are 2 judges? There can be difference in opinion. Okay. Then how the matter will be decided? Judicial member is saying something else, accountant member is saying something else. Then how to decide? Then whose opinion has to be considered? Then in that case, the president of ITAT will call all the judge in the ITAT room. So if the matter is tied between judicial member and accountant member, then the president of ITAT will call all the judge of the ITAT, including these 2 who is having tie match. And they will all sit together, they will discuss and they will discuss the matter based on majority. Okay. Based on majority, they will discuss. You can see over here. Next. Can an assessee go to ITAT during the appeal and tell the ITAT that appeal is going on, hearing is going on, and can an assessee go to appeal and tell the ITAT that please allow me additional ground? The answer is yes. It was held by Supreme Court in the case of National Thermal Power Company Limited that the ITAT has power to urge new grounds of appeal. That power is also there with CIT appeal, but that power is not there with AO. Remember Goetz India Limited, which says that if any new claim has to be admitted, the assessee has to make a revised return. It cannot be entertained through a mere application of plain paper. Do you remember that? I hope you remember. Next, this case law is removed by ICI, so you also remove because this section of 12AA is also removed by Finance Act 2020. Therefore, this case law is also removed by ICI. Okay, so you can remove this. Next, there was one assessee. His case was there in front of ITAT. So the assessee was not able to come to ITAT on time. So because the assessee was not able to come to the ITAT on time on the date of hearing, the judge was very angry. The ITAT judge was very angry and he passed an order against the assessee without listening to the assessee's lawyer. He did not listen to anybody and he passed an order without listening to the assessee's view, assessee's plea. So the question is, if the assessee was not able to make to the courtroom on time, can the judge pass an order against the assessee without considering the merit of the case? Without listening to the merit of the case, can he pass an order against the assessee just because the assessee did not come on time? The answer is no. The High Court said that the tribunal has done something wrong and tribunal has to reconsider the matter. Okay. Tribunal has to pass an order not on the basis of because assessee has not come, but tribunal has to pass an order only on the basis of merits. If the assessee is not able to come today, give him an opportunity. Let him come tomorrow, day after tomorrow, next week, next month. But you cannot pass an order without listening to him, without getting into the merits of the case. This is what this particular case says, that in the case of Srimati Rita Sabapati. And now, last but not least, let us conclude this. ITAT is the fact-finding authority. Last fact-finding authority. There are two types of questions which are generally appealed by assessee. One is called as question of fact. Another is called as question of law. So, if there is a question of fact, then it cannot be appealed beyond ITAT. ITAT is the last fact-finding authority. Now, if you want to go beyond this, that is, if you want to appeal in High Court or Supreme Court, your matter has to be a question of law. It cannot be a question of fact. Question of fact cannot be appealed to a High Court or Supreme Court under the income tax law. So if there is a question of law, you can go to High Court. And what is the time limit to go to High Court? 120 days. If you lose the case over there, you can go to Supreme Court. What is the time limit to go to Supreme Court? 90 days. Okay. I hope it is clear to all of you. Now let's move on to the next section, that is 158A. Now this section has been brought with an objective of avoiding repetitive appeal. Suppose there is a particular matter of say last year which is already pending in your case in High Court or Supreme Court. So in the current year, what sense does it make to appeal that same matter again to ITAT or to again to CIT appeal? It doesn't make any sense. So there is a question of law of earlier years in your case, which is already pending in High Court and Supreme Court, and Supreme Court, High Court have not given its verdict. So what sense does it make? It doesn't make any sense. So in that case, the government is giving you an option to the assessee that do not appeal in the current year and make an application to the AO in Form 8. You can make an application to AO, CIT appeal or ITAT in Form 8 and tell them that I am not appealing for the current year because my similar case is pending for last year. And whenever the matter of the last year will be disposed of by High Court or Supreme Court, we will together apply that case in the current year also. Whether I win or whether I lose, it doesn't matter. Even if I win, I will apply that case for current year. Even if I lose, I will apply that case for the current year. Now, the department may accept or may reject that particular claim of the assessee. If the department accepted, well and good. If the department does not accept, then you can go and file an appeal. Nobody will stop you in that case, okay? So, this is what this particular concept is all about, to reduce what? Repetitive appeals, okay? Next is special provisions for appeal by department, section 268A. Now, what is the first appellate authority for assessee? For assessee, the first appellate authority is CIT appeal. Now, what is the first appellate authority for department? For department, the first appellate authority is ITAT. So, the CBDT has fixed the monetary limit, which says that department will file an appeal to ITAT if the tax effect is more than 50 lakh rupees. And department will file an appeal to High Court if the tax effect is more than 1 crore rupees. And department will file an appeal to Supreme Court if the tax effect is more than 2 crore rupees. Now, the question is, what is tax effect? Tax effect means that the current tax minus the estimated tax if the department wins tomorrow by filing an appeal in ITAT or High Court or Supreme Court. The difference between the two is called as tax effect. Suppose the current tax is 1 CR and if the department file an appeals, then department might get a tax of 2.5 crore. So, the difference between 1 crore and 2.5 crore, that is 1.5 crore, will be considered as tax effect. So, this has been done again to reduce the burden on the judicial system so that unnecessary cases should not go to department. And department, at least from their side, are trying to relieve themselves from unnecessary cases. And the monetary limit set over here is too high. So, the question is, if the department is under this limit, that is under 50 lakhs, 1 CR, 2 CR, can department cannot appeal? It is not like that. It is at the discretion of the department. If the limit is within the prescribed limit, still if the department wishes to file an appeal, they can file an appeal. And you cannot stop the department to file an appeal. You cannot say that there is a circular which says that department shall file if the appeal, if the tax effect is more than 50 lakhs or 1 crore or 2 crore. It is only for the internal purpose and internal reference of the department. It is not binding on department. Department may follow this, department may not follow this. The ultimate conclusion is, if the tax effect is more than this amount, then the department will definitely file. But if the tax effect is less than this amount, department may file, may not file. That is at the discretion of the department. In case the department did not file, that does not mean that the assessee is correct. That does not mean that the other assessees will start to say that you have not filed appeal in his case. Why the hell you are filing an appeal in my case? Other assessees cannot say. You also cannot say in subsequent year that last year you have not filed an appeal for less than 50 lakhs. So in the current year, why you are filing an appeal for the current year? It cannot be said by the assessee. So this issue is assessee specific and it is year specific. Other assessees cannot take this as a precedent. The same assessee cannot take last year as a precedent that last year you have not filed an appeal while you are filing an appeal. Okay. So these are the few things which are given in section 268A. Unfortunately, this is now removed from next year onwards in Finance Act 2022. This section, not this section, sorry. This section is removed by Finance Act 2022. So this is the last year for November 2022 exams that this section is going to be learned by the students. Okay. Anyways, let us move on to the next chapter. It's not a next chapter. It can be considered as an extension of the current chapter itself. Now, after the assessment is done, the department will raise a notice of demand. Okay. And the notice of demand will say that you have to pay tax within 30 days. And if you do not pay within 30 days, you will be called as what? Assessee in default. Now, can department give you an extension? Yes, they can give you extension if you make an application. Can department give you an EMI facility, equity-dated monthly installment? The answer is yes, they will give you with interest. They will take interest, obviously. You can pay in installments, the taxes. The demand you can pay in installment, but with interest. Okay. Then comes, can department reduce your time limit of 30 days to say 10 days and say that, no, you will pay tax in 10 days, not 30 days? The answer is yes. Where the AO has reason to believe that giving 30 days is detrimental to the interest of revenue, he can reduce it. Pay attention over here. He can reduce it. Now, if the assessee does not pay within 30 days, then what will happen? If the assessee does not pay within 30 days, then the assessee will become assessee in default. So, what are the consequences of becoming an assessee in default? Then you have to follow the consequences mentioned in section 220, 221, 222, 225, 226. All these sections have to be fulfilled. Let us see one by one. The first one. Then you have to bear the consequences mentioned in section 220. What is mentioned in section 220? It is mentioned that the assessee will be liable for an interest of 1% per month or part thereof. Can this interest be waived? Yes, it can be waived by chief CIT or CIT if the three conditions are fulfilled at CC. You have to fulfill these three conditions. This is the mnemonic which I have used so that you can remember easily. HCC. You have to prove to CIT that delay was beyond control. You have to prove to CIT that there will be undue hardship on me if I have to pay the interest. And you have to prove to the CIT that you are always a cooperative assessee. So you have to make an application, you have to prove this condition. That delay was beyond control, there will be undue hardship if interest is charged on me, and I have always cooperated with the department. Then the CIT will pass an order within 12 months and will decide whether to accept the application for waiver or whether to reject the application for waiver. It will accept within 12 months. Okay. After that, you will be liable for penalty. Penalty will be how much? It will be equivalent to tax in arrears. It cannot be more than tax in arrears. It can be equivalent or less than tax in arrears. Okay. It can be equivalent to tax or less than tax. It cannot be more than tax. Then department will come into recovery mode. The tax recovery officer will prepare a certificate of action and will start to take action against you. First action, he will attach your properties. Attach means you cannot sell now. You can use it, but you cannot sell. He will appoint a manager to appoint your properties, and he can also do an auction of your property as per section 222 to 225. Then again in 226, there are some harsh measures which can be taken by the tax recovery officer. Again, he will prepare what? Certificate of action, and there are 4 more modes to recover the tax. First, he will give a notice to your employer. Suppose if you are working somewhere as an employee, he will give a notice to your employer and will say that pay the salary to the government of India from next month and not to the assessee. So suppose if I am a tax defaulter, a notice can go to my employer, and my employer will have to pay the taxes, will have to pay the salary to the government of India rather than to me. He will issue a garnishee order to debtor. It means he will issue orders to my debtors. That is known as garnishee order. And he will tell, the officer will tell, the TRO will tell the debtor that pay the money to the government of India, not to the assessee. Not to your debtor, not to your seller, but to the assessee. Third, he can request to the court. If the property of the assessee is in the custody of the court, the AO may request to court also to release the property. Okay. Last but not least, he may also go for a distrained sale. Distrained sale means what? It means he may go for a sale which is at almost no price. A 10 crore property can be sold at 4 crore. This is known as distrained sale. Distrained sale means something which is sold at any cost. You need to just remove that property at any cost. So AO can go for distrained sale also. These are some of the dangerous and Draculian consequences of what? Of being a assessee in default. I hope it is clear to all of you. But just go through it and then we'll go ahead. Now let us go ahead with the next discussion, and that is the revision under section 263. So there are 2 sections under which the Commissioner of Income Tax have been given the power with the revision under the income tax law. One is under 263 and another is under section 264. Now, in both the sections, the Commissioner will revise the order of the assessing officer. Now, what is the difference between these 2 sections? Under section 263, the CIT will revise the order which is prejudicial to the interest of the department. And under 264, the CIT will revise the order which is prejudicial to the interest of assessee. So, this is the basic and the main difference between the 2 sections. So, 263 is an order whereby the AO has passed an order which is harmful to the department, which is prejudicial to the department. So, the CIT might call for the records and rectify that particular error. And in 264, AO has passed an order which is harmful to the assessee, which is against the assessee. So the CIT will call for the record and will revise the order under section 264. Okay. So under 263, who is going to revise the order? It is the CIT or principal CIT or chief CIT or principal CIT. Whose order he is going to revise? He is going to revise the order of AO, which is erroneous and which is prejudicial to the interest of revenue. This is a very important condition. Then he will give an opportunity of being heard to the assessee, and after giving an opportunity of being heard, he will pass an order. What will be the scope of the order under section 263 of the CIT? The scope of the order of CIT under 263 will be as follows. Either CIT can enhance your income, or CIT can modify your income, or again now this power is there with CIT, which was there with ITAT also, but which was not there with what? CIT appeal. That is, CIT can direct the assessment for fresh assessment to AO and tell the AO to make the fresh assessment. This power was there with ITAT but not with CIT appeal. Now, what do I mean by the phrase erroneous and prejudicial to the interest of revenue? That phrase is defined under income tax law under an explanation to section 263. If somebody asks you, what do you mean by the phrase erroneous and prejudicial to the interest of revenue? It means any of the four things. If the CIT is satisfied that the order passed by the AO is without making any inquiries, if the AO has passed an order without making inquiry, then the CIT can say that the order passed by the AO is erroneous and prejudicial to the interest of revenue. If the CIT is of the opinion that the order passed by the AO is passed without inquiring about the relief which the assessee is going to get or not, AO has passed an order giving relief to the assessee without inquiring into the case. So he is giving the deduction, he is giving the relief to the assessee without inquiring. If the CIT is satisfied with that particular thing, in that case, CIT can revise the order under section 264 because it can be called as erroneous and prejudicial to the interest of revenue. Third, if the CIT is of the opinion that the AO is not following CBDT instructions under section 119, AO is not following CBDT circular, not following CBDT notification direction orders, or if the AO is not following the judgment of jurisdictional high court or the Supreme Court. So in either of the four cases, the CIT can what? Say that the order passed by the AO is erroneous and prejudicial to the interest of revenue, and therefore the CIT can revise the order of AO. CIT can only revise the order of AO, he cannot revise the intimation or deemed intimation. Intimation or deemed intimation can either be rectified under 154 or it can be appealed to CIT appeal. It cannot be revised under 263. Next, if you are not satisfied with the order of CIT under 263, you are not satisfied, you are aggrieved, you can go and file an appeal to ITAT. You can go and file an appeal. Next, before going into the proceeding of 263, it is the duty of CIT to first of all get into what? Give an opportunity of being heard to the assessee. It has to be given to the assessee, and after an opportunity of being heard is given to assessee, then only he should proceed. And if the assessee explains everything properly, then CIT has to drop section 263. Next, there is no need to give any show cause notice specifically, only opportunity of being heard is necessary to be given. Next, doctrine of partial merger is applicable here, like it was applicable in 154 rectification. As I've told you in earlier lecture also, the earlier part of this lecture also, that in 263 also there is a doctrine of partial merger. What is doctrine of partial merger? Doctrine of partial merger means if a particular part of an order is already in appeal, then that part cannot be touched in revision under 263. The CIT can touch other aspects but not the same aspect. This is doctrine of partial merger, which earlier came in section 154 also. Next, what is the time limit for the CIT to revise an order under 263? It is 2 years from the end of the financial year in which the order sought to be revised was passed. 2 years. But if the CIT is giving an effect to a High Court or Supreme Court judgment, then there is no time limit over here. It means if a High Court judgment came or a Supreme Court judgment came today in some other case, then the CIT can revise an order older than 2 years also. He can revise an order 4 years old also, 5 years old also, 3 years old also. Then the time limit of 2 years is not applicable for it. Next, there is a Bombay High Court judgment of ICICI Bank Limited and Supreme Court judgment of Elegant Finance Limited. Generally, the time limit to revise an order is 2 years from the end of the financial year in which the order sought to be revised. Now, what has happened in this case? AO has passed an order. Then AO opened 147. And then after that, AO want to revise certain matters which are given in the original order. But he is counting 2 years time limit from the second order. Again, I am saying AO has passed a regular assessment. Then after a few years, 147 assessment is done. And now AO want to revise the original order. So the time limit of 2 years will be counted from where? From the 147 order or the original order? The question is this. So the Supreme Court as well as the Bombay High Court has held that the time limit of 2 years will be counted from the original order, because here the AO wishes to revise the original order and not the interim order which was passed under 147. And therefore, 2 years lapse from original order, and therefore the AO, the CIT cannot revise the order under section 262. This is what section 263 is all about. Then let us come to section 264. Now what is 264? 264 is also a revision by CIT, but it is a revision where the AO has passed an order which is prejudicial to the assessee. So in this case, the CIT can suo motu also rectify, and assessee also can make an application for rectification. But in the previous section, assessee was not making any application. Obviously, no assessee will himself say and tell the department that pass an order against me. But in this section, an order is passed against me by the AO, so I can raise an objection. So in this section, even CIT can suo motu revise my order, or I can make an application. But there is one condition over here. What is that condition? A CIT cannot revise those orders under this section, that is 264, which are already covered in 263. It means if your order is subject to 263, then your 264 is not possible. Therefore, we can say one sentence. Once 263 has happened, 264 is not possible. But once 264 has happened, 263 is possible. So after 263, government says that 264 is not possible. But after 264, 263 is still possible. Now again here, the AO, the CIT will revise the order passed by AO. Again, CIT will not rectify or revise the intimation under or deemed intimation under section 143, 144, etc. 143 or 200A1 or 206CB1. You cannot revise intimation or deemed intimation. Again, CIT has the power here to cancel the assessment and direct fresh assessment. Now I am concluding this forever and I am making this great interlinking. The power to cancel the assessment and direct fresh assessment is with ITAT, is with CIT under 263 and is with CIT under 264, but this power is not with CIT appeal. This is something which I am concluding today itself. Now, what is the time limit? The time limit to pass an order. If the CIT revises the order on his own, if he revises the order on his own, then the time limit is 1 year from the date of passing. Whenever the AO has passed an order, within 1 year from the date of that order, the CIT can revise under 264. What is the time limit for the assessee to make an application? The assessee can make an application within 1 year from the date of communication of the order to him. Whenever the assessee has received the order from AO, communication means received. Whenever the assessee has received the order from AO, from that date in 1 year, the assessee has to make an application under section 264. Can that be extended? Yes, it can be extended if there is a sufficient cause for a delay. Then, after I gave the application, in how much time CIT will complete the revision under 264? For that, there is a third time limit, that is within 1 year from the end of the financial year in which the application is made by the assessee. So, once the assessee makes an application, then the CIT will consider that application and will pass a revision order within 1 year from the end of the financial year in which the application is made by the assessee. So, there are 3 time limits over here. You can see it carefully. Okay. Now, this is a very important aspect of this section. Under what circumstances revision under 264 is absolutely impossible? First, if there is an AO's order and there are 100 matters in AO's order, even if you appeal on one matter, even if you go for an appeal on one matter, you cannot go for revision for the remaining 99 also. There are 100 matters in AO's order. Even if you appeal one matter, you cannot go for revision under 264 for the remaining 99 items also. This is known as doctrine of complete merger. Unlike doctrine of partial merger, which is there in 154 and 263, what happens over there? What happens over there is, if there is an AO's order and there is one matter which is appealed, you can go for the remaining 99. But here in 264, you cannot touch any matter if once a particular item is appealed. This is known as doctrine of complete merger. Second, generally after AO's order, you have 30 days time to appeal. So, within the time limit of appeal, that is within 30 days, you cannot make a revision application. You have to make a revision application after expiry of the time limit of the appeal, that is after 30 days. But if you want to make an application within that 30 days only, you have received an order, for the 30 days you have to wait. After 30 days you can make an application for revision. But you wish to make an application within that 30 days, then you have to give an undertaking to the department that I waive the right to appeal. So you have to file a waiver application and then only you can go for a revision application within 30 days of the appeal. After 30 days expired, you are free to go for the revision application. Okay. Now, once the CIT passes an order and if you are not satisfied with the order, then appeal is not possible against this order. Pay attention over here. It is not possible for an appeal. Not possible. You cannot appeal. You cannot appeal this particular order. So, can I file a writ petition in High Court? Yes, you can file a writ petition in High Court or Supreme Court. That is something which is allowed to you. Okay. Now, can CIT rectify its order if there is a mistake apparent from record? Definitely. 154 is for all income tax authority if there is a mistake apparent from record in their order. So, if there is a mistake apparent from record, that can be rectified. There is no issue in that. Okay. But appeal is not possible. So, this is what the provision of 263 and 264 is all about. Now, below this, I would request you all to go through it, that I have put some similarities of both the sections and then I have put some distinction between of both the sections for your better understanding of the subject. Okay. You can understand this by reading at your end. Okay. This covers all the things which I have covered in the previous 2 pages. Now, the next topic is again for your reference. I have made a compilation of all the time limits which are there under the assessment so far. Okay. Whatever time limits are there under the assessment so far, I have made a compilation of that for you all. You can see over here. Can you see this? This is the time limit for 139.1. What is the time limit for 139.1? It is either July, October or November. 139.3 same as above. Then 139.4 before the end of December or before completion of assessment, whichever is earlier. 139.5 also same time limit. 139.9 defective return 15 days or as extended. 142 unnoticed, time limit will be specified in the notice. 142.2a as specified in the special audit direction, it can be extended but total cannot exceed 180 days. 142 evaluation report within 6 months. 143 one intimation has to be sent within 9 months from the end of the financial year in which the ROI was filed. 143 regular assessment. There are two time limits which you have to keep in mind. First, the scrutiny notice has to be served within 3 months from the end of the financial year in which the return was filed. Here it is served, here it is sent. In 143.1 it is sent. And then what is the time limit to pass an order? It is 9 months from the end of the relevant AY plus 12 months extra if the matter is referred to transfer pricing officer. Then 144 show cause notice, there is no time limit. But 153.1 time limit is same as the previous one. This order will also be passed within 9 months from the end of the within 9 months from the end of the relevant assessment year plus 12 months extra if the matter is referred to TPU. Okay. Then in 147 there are multiple time limits. 148 is the notice for you whereby you will file the return. The time limit to file the return will be specified in notice. 149, that is the time limit to issue notice. If your normal case, it is to be issued within 3 months, within 3 years from the end of the relevant AY. But if your case is special, where the escaped income is likely to be greater than or equal to 50 lakhs and it is represented in the form of asset, then it can be issued within 10 years from the end of relevant AY. And what is the time limit to pass income escaping assessment? It is 12 months from the end of the financial year in which the notice under 148 was served to the assessee, plus 12 months extra if the matter is referred to what TPO. Then rectification time limit, just in last few lectures I have told you. The by default, if the department so modo rectify, it is 4 years. If the assessee makes an application, then it has to be rectified faster within 6 months. Then revision time limits, I have told you just now. Okay. So one-stop solution for you all. If you are confused about the time limit, you can just go through these 2 pages and your assessment time limits will be completed. Okay. Now let us move on to the next topic, which is a very, very, very important topic. Mark this topic as one of the most important topic of your CA final direct tax paper, from which you are going to get one question of around 8 to 10 marks in the exam for sure. This is a must-do topic before exam. Must do, and must do. Okay. I have put enough emphasis for you to understand how important this topic can be in the exam. So let us start with the topic of taxation of trust. There is one more part in this, that is taxation of accredited income and exit tax, that will take some time later, okay, in the subsequent revision video. Today I am interested in taxation of trust and what does this topic means. First of all, we need to understand there are 2 types of trust which can be there. One is known as charitable trust, one is known as religious trust, and both are different. The word religious purpose is not defined under income tax law, whereas the word charitable purpose is defined under income tax law in section 2 clause 15. So first of all, we need to understand what do you mean by the phrase charitable purpose. The word charitable purpose means, rather it includes, it is defined in section 2 clause 15 as follows. Charitable purpose includes relief of poor, education, medical relief, yoga, preservation of environment, preservation of monument, any other object of general public utility. So if you see the first 5 to 6 points, those are very specific points. But if you see the 7th point, it is a very general point. The general point says that any other object of general public utility. So the 7th point comes with a rider. It comes with a condition. And what is the condition? Let us try to understand that. The 7th point comes with a condition. The first 6 point does not have any kind of condition. So what is the condition in the 7th point? That is this one. What is the condition for this particular point? The condition for this particular point is your aggregate commercial receipts in a financial year should not exceed 20% of total receipts. So if you are covering the 7th point, if you are doing any other object of general public utility, then there is a condition which you have to fulfill. For the first 6 category of assessments, there is no condition to be fulfilled. But for the 7th category, the condition is your commercial receipts. Your commercial receipts should not exceed 20% of what? Your total receipts. This is the condition which you have to fulfill. Now, coming to the next part, the first thing which we need to understand over here is the treatment of donation. How donation is under tax law. Now, there are 2 types of donation which can be received by the trust under the income tax law. One, where the identity of the donor is known. Another, where the identity of the donor is not known, commonly known as anonymous donation. Let us talk about where the identity of the donor is known. Under that category also, there are 2 subcategories. Where the identity of the donor is known, there are 2 subcategories in that. One is known as corpus donation. One is known as voluntary donation. Now, what is a corpus donation? A corpus donation means the donor is giving you donation with an intention that it should be used for a specific purpose. And you have to use that particular donation for a specific purpose only. You cannot use it for general purpose. And voluntary donation given by the person is, it can be used for any general purpose of the trust. So in that also, the voluntary donation which is received from the donor is absolutely taxable. As you can see over here, you have to add to your income statement. But the corpus donation which you receive is not taxable. It is not an income, but there is some amendment which is made by Finance Act 2021 which we will see in some time. Okay, so let us conclude for as of now that voluntary donation will be added to income statement because it is taxable, and corpus donation will not be added to statement because it is not taxable. But for corpus donation, we need to see some kind of amendment made by Finance Act 2021. Now, what about the donation for which there is no identity of the donor? That is the donation which is an anonymous donation. Those are covered under 115 BBC and it is taxed at 30%. We will talk about that sometime later. Now, how a trust will compute its income? The computation of trust will be done as per this statement. A trust will compute its income as per this statement. First of all, trust will write income from trust, which will include all kind of income of the trust. All kind of income of the trust will come under this first point. All. There is no 5 heads of income applicable to trust. There is nothing like that applicable to trust. All kind of income of a trust will come under this point. That is income from trust. That is gross fees minus expenses. Okay. Then you will add what? What is this? This is the net income of the trust. Whatever income trust is earning, you have to put here only. Suppose trust is earning some rental income, you have to put here in first point. Suppose trust is earning some interest from bank, you have to put here. Suppose trust is receiving some fees from students and incurring some expenses for them, then the net profit has to be put over here. Okay. Then comes voluntary donation. Voluntary donation, because corpus donation is by default not taxable. But there are some amendments which we will see in a while. Then comes the total. After the total comes, you will get a flat 15% exemption under 11(1) out of these two incomes. Flat 15%. Then whatever is the amount left, you have to apply for charitable or religious purpose. You have to apply for your trust. You have to use that money for the trust. And if you apply the money for the trust, you will start to get exemption. If you do not apply, you will start to pay tax. This is the format you have to follow. For the purpose of what? Computation of total income of a trust. Now, what do I mean by the phrase application for charitable or religious purpose? The word application is very wider as compared to the word expenditure or expense. It will include lot of things. It will include repayment of loans. It will even include purchase of capital asset. But then don't claim depreciation. You will not get depreciation once you claim the purchase of capital asset as an application. For example, you have purchased a plant and machinery. You are claiming that plant and machinery as an application. Then you cannot claim depreciation on that same plant and machinery and claim dual benefit. It is not allowed. Even payment of taxes, income tax payment is also allowed as deduction. Do you remember? By default, income taxes are not allowed under PGBP. But here, income tax is allowed as deduction. Even giving education loan to students is allowed as deduction. Just one thing is not allowed as deduction, and that is removed by Finance Act 2021. Let me explain you that. Suppose in the last year, you have made an excess application. So there is a loss in last year. So till last year, what used to happen? Whatever excess application you have made in the last year, you can carry forward and set off against the income of the current year. But Finance Act 2021 has made an amendment by putting an explanation 5 to section 11(1), which says that excess application of last year cannot be set off in the current year. It is not allowed. Now, this list is only illustrative. It is not exhaustive. Okay. Now, whatever amount is left over here, that is 10 lakh. You have to pay tax on that. Sir, is there any way that I can save tax on that also? Yes, you can. There are a lot of ways in which you can save tax. I'll be talking about that in a while. But apart from that, sir, as you said, for trust, there is no 5 heads of income. There is no 5 heads of income. For trust, the income computation will be done as per this statement only. But sir, will the trust be considering any kind of disallowances which happens in PGBP? Only 2 disallowances are applicable to trust, which are applicable to generally PGBP SSE. One is 40A 1A, whereby when you make payment to resident and do not deduct TDS, the expenditure gets disallowed. So now that disallowance is extended to trust also. And second is 40A 3 or 3A, where you make payment in excess of 10,000 rupees by cash or by bearer check, that is by other than account pay check, account pay draft, ECS, or such other electronic mode. Moral of the story, let me tell you, only these 2 disallowances of PGBP are allowed, are to be considered under trust. Apart from these 2 disallowances, no other disallowances of PGBP are to be considered for the purpose of computing a trust income. I hope it is clear to all of you. Now, please tell us, sir, some ways to save the tax of a trust. There are 4 ways in which you can save tax. First, if you want to save tax on this 10 lakh rupees, which is left as an amount, you have applied 15 lakh 50,000, still 10 lakh is left. If you want to save tax on that, just make sure that you make a donation to another person. You make a donation to another trust which is registered under 12AA, 12AB or 1023C. So if you are not able to incur that expenditure for the welfare of the people, donate to someone else who will incur that for the welfare of people. But listen carefully. Finance Act 2020 has made an amendment and said that only a voluntary donation will be considered as an application. It means if I give donation to someone and it is a corpus donation to someone, then that is not allowed to me as a deduction. Something which is written over here. Only a voluntary donation will be allowed as deduction to the SSE. Corpus donation will not be allowed. These are small things which are tested in the paper, which you need to know before the exams. And unless and until you are aware of these small things, you will not be able to crack a difficult paper. This is something which we do in great detail in our regular batches. in great detail with questions for each and every aspect of the syllabus. But here time is a constraint. I have to revise that as fast as possible. So here question solving is not possible for me. Okay. So the first way to save taxes, donate to another trust which is registered under 12AA or 1023C. And the donation has to be a voluntary donation and not a corpus donation. Corpus donation will not be allowed as deduction. Next, you are not able to apply the money because you have not received it. So if you have not received it, that is the reason you are not able to apply the money. So in that case, the government says that you can claim exemption today and you have to apply in the year in which you receive or in the year following the receipt. So if you receive in 2025-26, you can claim exemption today. Because you have not received, you can claim exemption today and then you can apply, say, in the year in which you receive or the year following the receipt. So if you receive in 25-26, apply in 25-26 and 1 year more. That is, even in 26-27, you can apply. Government is giving you a grace of 1 year. So if you do not apply till 26-27, then it will be deemed income of 26-27. Okay. So today, claim exemption. Whenever you will receive, apply that money for the objects of the trust in that year or in subsequent year. So in subsequent year, if you do not apply, it will be income of subsequent year. Okay. This is what it is written over here. Next. I do not want to apply the income in the current year because I wish to accumulate that for future years. So you can do so. So if you wish to accumulate that 10 lakh for future years, so you can claim exemption today itself by following certain procedure. First, you have to go to assessing officer and make an application to him, and you have to go to assessing officer on or before the due date of filing of return. And you have to make an application to him saying that I am accumulating this amount for a specified purpose. You have to mention that specified purpose and you have to accumulate that money maximum for 5 years. So you have to accumulate that money maximum for 5 years and you have to apply that in the 6th year. So ignore the current year. Current year is 21-22. Ignore this year. Apart from this year, count 5 more years. 22, 23, 23, 24, 24, 25, 25, 26, 26, 27. You have to accumulate till 26, 27 and you have to apply till 27, 28. And if you do not apply till 27, 28, it will be deemed income of 27, 28. That is, it will be deemed income of the 6th year. At the same time, you have to fulfill certain conditions as I have told you. You have to go to assessing officer. You have to make an application to the assessing officer stating the purpose, stating the period. The period of accumulation cannot be more than 5 years. Then, at the same time, you have to invest that money which you are going to accumulate in certain government specified notified securities which are mentioned in 11.5. Sir, can I withdraw that money in future years and apply for some other purpose? No, it will be deemed income. Sir, can I withdraw that money and give donation to somebody else? No, it will be deemed income. You have to withdraw that and apply for the specified purpose which I have mentioned earlier. Otherwise, it will be deemed income. Okay. And if you do not apply till the 6th year, it will be deemed income of 6th year. Last but not least, the fourth reason. What is the fourth reason over here? The fourth reason over here which says that, listen carefully all of you. This is a grace period given by the government for 1 year for every trust. Suppose you are not able to apply in the current year, you can take a grace of 1 year. But then you have to apply in the immediately next year. So if you are not able to apply in previous year 21-22, take a grace of 1 year, but you have to apply that in the subsequent year immediately. That is 22-23. And if you do not apply in 22-23, that amount will become deemed income of 22-23. The unutilized portion will become deemed income, not the entire amount. Suppose you are claiming an exemption of 10 lakh, and if you apply 6 lakhs in the next year, then deemed income will be 4 lakh only. Okay. So these are some of the reasons by which you can save your tax. Okay. Now, as I was telling you that there was some amendment which was made under the corpus donation. By default, till last year, receiving a corpus donation was exempt. But now the government is saying that there are some conditions which you have to fulfill to make it exempt. Now, what are those conditions? So, listen these conditions carefully for corpus donation. Let me tell you once again. By default, if you receive a corpus donation, it is exempt. But now there are some conditions. First, when you receive a corpus donation, if you want to make it exempt, then you have to invest that corpus donation in the mode specified in 11.5. So now if you receive 100 crore, you want to make it exempt, then you have to invest that 100 crore in 11.5, otherwise it is taxable. So if you receive and invest, then it is exempt. Now whenever you will withdraw that money out of the modes you have invested, suppose you have invested in certain government security. So when you will withdraw and then you will apply for the trust, it will not be considered as an application. It will not be considered as an application. Listen carefully. Again I am saying, when you receive a corpus donation, you want to make it exempt, invest in the mode specified by the government. Okay. Now you have invested in the mode specified in the government. The corpus donation is exempt. Now when you withdraw the money and apply for the trust, it is not considered as an application. It is not allowed as a deduction. Now later on, when you will earn some money, and again reinvest that back in the mode specified in 11.5, at that time it will be considered as an application. So when you make an actual application, it is not allowed as deduction. But when you earn some money and again reinvest in the mode specified in 11.5, it will be allowed as deduction. See carefully. Okay. Next. If you take a loan and if you apply that loan for some purpose, then that is not allowed as deduction. Suppose if I took a loan and I bought a property, then that is not considered as an application of income. But When I repay that loan, at that time it is considered as an application of income. Please check this. This is also a Finance Act 2021 amendment. Whatever is in green is an amendment made by Finance Act 2021. Okay. Next, Section 11 subsection 7. What does it say? Listen carefully. What does it say? It says that once you are registered under 12AA or 12AB, it means you are a registered trust and your registration is in force, then you won't get any exemption under Section 10 except 3 Section 10 exemptions. Again, I am saying, once you are a registered trust under 12AA or 12AB, then you won't get any exemptions under Section 10 except 3. Which are those 3? You will get 10(1), you will get 1023C, and you will get 1046. These are the only 3 exemptions which you will get if you are a registered trust. Apart from this, you are not going to get any other exemptions under Section 10. Now, in this also, there is an amendment. You have to choose between this and these 2. This is something which is always exempt. 10(1) is always exempt because that is agricultural income. But between 12AA, 12AB and 1023C, 1046 also you have to choose. If you are claiming 12AA, 12AB, now then you cannot claim 1023C, 1046. You have to forego that. Or if you are claiming 1023C or 1046, you have to forego 12AA or 12AB. You have to take either of them now. You cannot take both of them in the same year. This is the amendment which is made by first proviso and second proviso. But 10(1) can be claimed by everyone. 10(1) is something which is exempt for everyone. There is no condition for that. Okay. Next, for claiming exemption under Section 11, you need to be a trust which is registered. And for that purpose, you have to make an application, and you will make an application to CIT. So you have to make an application to CIT. So once you make an application, you can enjoy the exemptions over here. Okay. Further, you have to conduct audit, you have to file ITR, etc. These are some basic conditions which a trust has to fulfill. Now, there are certain provisos below this, which says that, listen carefully. Suppose if I make an application in the current year, from when I will get exemption? From the current year itself. Suppose if I make an application in 21-22, from when I will get the exemption? As per Section 12A, you will get exemption from the year in which you make the application. So if I make an application in 21-22, I can enjoy exemption for 21-22 and future years. But the question is, can I enjoy exemption for past years? I am a trust since last 10 years, but I have not registered. I am registering in the current year. So if I register in the current year, I will enjoy exemption definitely for current year and future years. Will I enjoy exemption for last years also? So for that, government has made certain proviso, second proviso, which says that you can enjoy exemption for past years also, provided on the date on which you got the registration, that is in the current year, your assessment for past year should be pending in front of AO. If your assessment of past year is completed, then go from here, then get lost. But if your assessment for earlier year is pending on the date of registration and your objects of today and objects of last year are similar, then you can claim exemption for earlier year also as per second proviso. Third proviso says what? If you have claimed exemption for earlier years without a registration, and if AO comes to know about that later on, then AO cannot open 147 for that reason. 147 cannot be opened for non-registration grounds. It can be opened for other reasons. It can be opened if you have genuinely made a mistake, if you have genuinely escaped an income, AO can open 147. But just because you have not registered yourself, that cannot be the ground for opening 147 by the assessing officer. I hope it is clear to all of you. Fourth provision. So this is the benefit which is given to you, that you can claim exemption for earlier year also. If you claim exemption for earlier year, 147 will not be opened against you on the grounds of non-registration. And the fourth proviso says that the above proviso will not be applicable if earlier the registration was cancelled or registration was refused by the AO. So if earlier AO has refused the registration or he has cancelled the registration, then the benefit of exemption will not be given for past years. It will be only given for the current year and future year. Okay. Now, once you make an application, what is the duty of the CIT? The CIT will go through the application, will call for certain documents and will satisfy himself, and he will pass an order either registering your trust or he will pass an order for refusing your trust. If he is refusing your registration, then he will give an opportunity of being heard to the assessee. Okay. And what is the time limit for granting or refusing registration? It is 6 months from the end of the month in which the application was received. So if the application is received in the month of July, so 6 months from the end of the month will complete in the month of Jan 2023. Okay. I hope it is clear to all of you. And if within 6 months, if the AO is not passing any, or if the CIT is not passing any order, then you assume that you are deemed to be registered. Okay. Now, the next one, this case law is removed by ICI, so you can also remove, okay? You can also remove this particular case law, okay? Now, once you get registered, what do you feel? Can the CIT cancel your registration later on? The answer is yes. CIT has the power to cancel your registration if he is satisfied that the activities of the trust are not genuine. He is feeling that the trust is not doing genuine activity. He can cancel the registration. Or second, if the trust feels that, if the CIT feels that the trust are not doing its activity in accordance with the objects of the trust, So if the activity of the trust is not genuine or it is not in accordance with the objects of the trust CIT can cancel the registration. Okay. It can also cancel the registration for some other reasons also, which I'll be speaking sometime later. Okay. Now, while granting registration and also while cancelling the registration, while granting as well as while cancelling, CIT also has to consider that assessee should not violate any other law in this country. Suppose the trust is receiving some foreign contribution to assess. So the trust has to follow the Foreign Contribution Act. So CIT feels that the trust is receiving some foreign contribution, some foreign donation from outside India, and the assessee, that is the trust, is not following the Foreign Contribution Act. So in that case, the CIT can cancel the registration. The CIT can refuse the registration also, because the CIT has to make sure that the trust also follows other laws in this country. Last but not least over here, if a trust change its object, then what is the duty of the trust? If a trust in future change its objects, then it is the duty of the trust to, listen carefully, make a fresh application within 30 days from the change of the object to apply for a what? To apply for a fresh registration. It is the duty of the trust to make a fresh application. Now, all these things are covered in 12AA. But unfortunately or fortunately, whichever way you take, 12AA is not applicable from 1st April 2021. So from when? So from 1st April 2021, what is applicable? From 1st April 2021, a new section 12AB is applicable. Now, what does 12AB has to say? 12AB is an absolutely new section, which removes the old section 12AA and it brings a new section 12AB. And under 12AB, there has to be a drastic change which has to be done. First of all the trusts who are registered earlier under 12AA have to re-register themselves under 12AB. Re-register. All the trusts which are registered since last 75 years of independence, they have to re-register under 12AB. Secondly, all the new trusts will not be directly given any kind of registration. First of all, every new trust which will come now will be given registration of provisional nature for 3 years, and then they have to apply a final registration application, and then they will be given a final registration for 5 years, and after 5 years every trust has to make a reapplication. So now a trust will be getting a registration maximum for 5 years. After that you have to make an application, and if your application is accepted, it can be extended for another 5 years. So here these are different criteria over here. Listen carefully. The first category is, the first column is different entities. Second column is time limit for filing an application, and it has to be done online now. Then by when the CIT will grant you registration, then from which year you will get exemption, and then for how many years you will get exemption. Try to understand the columns. First of all the trusts which are existing trusts on 31st March 2021 which are already registered under the old law, they have to make a fresh application on or before 30th June 2021, that is within 3 months from this date, but this date is now extended by CBDT to 31st March 2022. So CBDT has extended this date to how much? From 30th June to 31st March 2022. Once you make an application, the CIT will give you registration within 3 months. And from there your exemption will start. For how many years? For 5 years. Year by 5 years, because you are already an existing trust, so you will be getting directly for 5 years. There is no provisional concept for you. Provisional concept is only for new trust. So if you are a new trust, then you have to make an application at least 1 month prior to the commencement of the year. So before the year commences, you have to make an application, and then within 1 month the department, that is the CIT, will grant registration, and then your exemption will start from the AY. And then you will be getting a provisional registration for just 3 years. It will be a provisional registration, and then you have to make a final application for final registration after 3 years. Next, a trust which is provisional registration means a trust which is registered over here has to come over here and make a final application. Whenever the 3 years period will expire, it has to come within 6 months before that. Within 6 months before that. So if the 3 years expires on 31st March 2025, then you have to come 6 months before that. That is, you have to come till 30th September 2024. And then the registration will be granted by the CIT within 6 months. And then you will be getting 5 years ka total time limit, which will include 3 years provisional plus 2 years extra final registration. Total 5 years. It is not another 5 years. 3 year provisional registration is already gone. So 2 years more you will get. Next, a trust which is already registered in 12AB, as I have told you, all of them who are going to be registered under 12AB, in the new section also, after 5 years, they have to make a fresh application. Again, they have to make an application 6 months prior to the expiry. Suppose it is expiring on 31st March 2028, so you have to make an application 6 months prior to that. Then the department will give you registration within 6 months, and then you will be given 5 years extra registration. A trust who has become inoperative under 11.7. Why it has become inoperative? A trust which has become inoperative due to 11.7. Why? Because earlier the trust started to take, just now I have told you, you can either take 1023C, 1046 or 12AA, 12AB. You cannot take both. So suppose a trust wishes to surrender 1023C and 1046. So now that trust wants to take 12AB. So they also have to make an application within 6 months. Within 6 months, they will pass an order and you will be getting what? A registration for 5 years. Next, suppose a trust whose objects have changed. Just now I have told you just above this particular table. A trust whose objects have changed. That trust has to make an application, as I've told you, within 30 days, a fresh application for the change of object, and then within 6 months, the CIT will grant you registration, you will get exemption, and you will get exemption for 5 years. So these are the different categories which are covered under the chapter of trust. I hope it is clear to all of you. And this new table is extremely important. And this first time limit is extended by CBDT from 30th June to 31st March 2022. Anyways, it has already been asked in May 2022 exam. So the chances of this coming in November 22 is less, is very less. Okay. Now coming to the next point, section 11(1)(a), exemption of capital gains for trust. How a trust will claim exemptions of capital gains. Listen carefully. Suppose this is FVC, this is expenses on transfer, this is net consideration. Keep this thing in mind. Keep this thing in mind. And this is cost of acquisition, this is capital gains. So now, if the trust wishes to claim this as an exemption, if the trust wants to claim exemption of 3 lakh rupees, the law is very clear. The trust has to invest the net consideration entirely. If 9 lakh is invested in the new capital asset, if 9 lakh is invested in new, that is net consideration is invested in new capital asset, then the assessee will be getting an exemption of 3 lakh rupees. So if the assessee does not invest 9 lakh, suppose if the assessee invests 8 lakh rupees, then the exemption will be restricted to cost of new asset minus cost of old asset, which is 6 lakh. Exemption will be only 2 lakhs and 1 lakh will be taxable. So if the assessee wants to claim entire exemption, then the assessee has to invest entire 9 lakh rupees net sale consideration. If he invests less than that, then the cost of new asset minus cost of old asset, the differential amount will be exempt and the balance amount will be taxable, as you can see over here. Okay. Next, 13(8), what does it say? Suppose there is a trust who is covered under any other object of general public utility. Do you remember that at the beginning of this chapter we have seen that the 7th point of section 2 clause 15, the definition of charitable purpose, where it is written that if you are covered under the 7th point of the definition of charitable purpose, in that case you will be allowed exemption only if your commercial receipt does not exceed 20% of total receipt. It has to be within 20% of total receipts. Now suppose if the commercial receipt exceeds 20% of total receipts, then what will happen? You will not get exemption. So the question is, will my registration also will be cancelled? The answer is no. The registration will not be cancelled, don't worry. Your registration will not be cancelled. Only your exemption will be denied to you. Your registration will remain intact, don't worry about it. Okay. And one last thing over here is how anonymous donation is taxable under the income tax law. It is taxable under income tax law at 31.2%. But how? How? What is an anonymous donation? An anonymous donation means a donation where the identity of the donor is not known to us. We do not know the identity of the donor. That donation is anonymous donation. Okay. So let us take an example. Suppose I receive a total donation of 100 lakh. Out of it, anonymous donation is 10 lakh and other donation is 90 lakh. So will this 10 lakh be taxable at 30% directly? The answer is no. It is not directly it is not directly taxed at 30%, but it is taxed as follows. You have to write 10 lakhs over here and then you will get one exemption out of it. There is only one exemption which is allowed out of it. What is that exemption? 5% of total donation or rupees 1 lakh, whichever is higher. So in this case, 5% of total donations come to 5 lakh and 5 lakh and 1 lakh, whichever is higher, will come to 5 lakhs. This is the only exemption which you are going to get from anonymous donation. No other exemption you are going to get from anonymous donation. 5% of total donation or rupees 1 lakh, whichever is higher, will be allowed as deduction to you. You took the deduction, 5 lakh left. Now on this 5 lakh, you will pay 30% tax plus surcharge if applicable plus cess always of 4%. Now what will be the fate of this 5 lakh which is getting exempt over here? Listen carefully. The fate of this 5 lakh will be as follows. This is exempt over here. Okay, now do not ignore it completely. You will add this 5 lakh to a normal income statement. As you can see, normal income statement, you will add that. You will claim 15% exemption out of that 5 lakh which is getting exempt over here, and you can apply the balance amount and you can claim exemption under section 11. Moral of the story, the amount which is getting exempted over here is not going to be left like that only. You have to add that to the normal income statement and then claim 15% exemption on that. And after that, you have to apply that particular, if you want, apply for charitable or religious purpose if you want to claim an exemption on that. Okay. I hope it is clear to all of you. Now, sir, this anonymous donation, can I generally apply under section 11 and 12 and can I claim exemption under 11 and 12? Not allowed. It is not allowed. There is only one exemption which is allowed for it. That is this one. That is only this one. And whatever is getting exempted over here, you can use 15% and then you, whatever, listen carefully once again. The anonymous donation which is over here, there is only one exemption for that. And whatever is getting exempted over here, for that you can treat like a normal donation. And you can claim exemption of 15% and apply the balance amount. Okay. Now, anonymous donation is not applicable for certain people. A trust which is wholly registered, anonymous donation is not applicable. It is not applicable. It is not applicable to a trust which is wholly registered. It means for them, it will be treated like a normal donation. Okay. They will add to income statement, they will reduce 15%, so on and so forth. Which trust? Like mandir, masjid, etc. etc. Now, if a trust is partly charitable, partly religious, then the trust has to maintain two donation boxes. One for charitable purpose, one for religious purpose. And the amount received in the charitable purpose donation box will be applicable 115 BBC, and the amount received in the religious purpose donation box 115 BBC will not be applicable. So you have to keep two donation boxes in your entity, in your trust. One, and you have to mention over there, this money will be used for charitable purpose. This money will be used for religious purpose, and accordingly the department will do the treatment. Okay, I hope it is clear to all of you. And one last but not least, that is, there are certain institutions, universities, hospital, education institutions, medical institutions whose income is exempt under section 1023C. So let us see who are those institutions, etc. etc. First of all, category number 1. In this, there are two categories. 1023C clause 3AB and clause 3AC. Right? This is 3AB. This is 3AC. You can see. So this first one is for education purpose, and this second one is for health purpose. You can see, and both of them are substantially financed by government. So these are universities and these are hospitals. These are universities and these are hospitals which are substantially financed by government, whose income is fully exempt. Fully exempt under 1023C. You can see over here. I hope it is clear to all of you. Okay. Let us move on to the third one. Now, these are the educational institution, hospital, medical institution which are not financed by government, but these are also registered institutions. They are solely for education purpose. They are solely for hospital or other purpose. And if their annual receipts in the entire year does not exceed 5 crore rupees, till last year it was 1 crore, but from this year onwards, they have been given a limit of 5 crore rupees. So if there is an education institution which is registered under this clause, or there is an hospital which is registered under this clause, and their annual receipt does not exceed 5 crore, they are not liable to tax. So if their annual receipts exceed 5 crore, then they are liable to tax. Okay. And how to compute this 5 crore? This 5 crore has to be computed collectively. Suppose I have a trust which is having hospital also, which is having school also, and cumulatively if the receipt exceeds 5 crore, I will be liable for what? I will be liable for tax. That 5 crore should not exceed cumulatively also. Okay, I hope it is clear to all of you. Next, then certain charitable purpose institution, then certain religious purpose institution, any other university registered under different clauses, their income is also not subject to tax. Okay, so this is something which is very straightforward. Nothing great as such is there in this particular section. Okay, nothing much important. You need to just keep this thing in mind, that this limit is exceeded from 1 crore to how much? 5 crore, because this is the Finance Act 2021 amendment. Okay. So let's go ahead with the next topic, and that is a small topic which talks about certain profit link deductions. We are going to learn around 8 profit link deductions under this chapter, which will help us to analyze the next topic, and that is minimum alternate tax, which is one of the most important topic of your CA final syllabus. Okay. So now these are the deductions which are profit link deductions. There are different kinds of deduction under chapter 6A. One is profit link deduction, one is payment link deduction, one is other deduction. So there are multiple kinds of deductions under chapter 6A with respect to chapter 6A deductions. So today we are talking about profit link deductions. Profit link deductions means a deduction which is available on earning some profits. In CA Inter, you have done payment link deductions like ATC, ATD, ATG. All these deductions are allowed on making certain payments. But this one is not allowed on making certain payments. This one is allowed on earning certain incomes. So in all these profit link deduction, you have to remember 3 things. First of all, the nature of business which is covered in the section. Second, the percentage of deduction. The third, the period of deduction, for how many years you are going to get this deduction. Okay. So let us start with the discussion. The first thing which we need to understand over here is the nature of deduction under 80IB. Under 80IB, the first business which is covered is industrial undertaking. Industrial means manufacturing associate, and where you need to begin your production on or before 31st March 2004. If you have started your production after this period, then you are not eligible for this deduction. Okay. Second, you should be engaged in construction and development of housing project, or you should be engaged in production or refining of mineral oil in any part of India, or you should be engaged in food grain business like handling, storage, transportation, or you should be engaged in again the business of packaging or preservation or processing of fruits, vegetable, meat or meat products, poultry, dairy, marine products. Okay. Or you should be engaged in the business of a hospital of at least 100 beds in anywhere in India, excluding certain areas. So these are certain business which you have to ultimately remember. Secondly, for how many years I am going to get this deduction? This deduction will be available for 10 years. For the first 5 years, you are going to get 100% of the profit as deduction under chapter 6A. And for the next 5 years, you are going to get 25% deduction under chapter 6A, 30% in case you are a company. So for the next 5 years, it is 25% for individual HUF, firm, AOP, VY, etc., and 30% for company assessees. Okay. Now, in case of industrial undertaking, that is the first point. There is one more condition which the assessee has fulfilled. Okay. So please be careful with this condition. If you are an industrial undertaking and if you are doing manufacturing with the aid of power, there has to be at least 10 workers in your business. And if you are doing business without the aid of power, it means your business is labor intensive, not machine intensive. Power is not required for manufacturing. Then you should have at least 20 workers in your business. Okay. So this is your first section. The different kind of businesses which are covered. The period is 10 years and the percentage is 100% for first 5 years and 25 or 30% in the last 5 years. Okay. Next deduction, ATIA. In this, there are three business which is covered. First is telecommunication and internet services. But between this 10 year, that is 95 to 2005, if your business is commenced, only then this deduction is available. So if you commence your business today, then this deduction is not available. If you have commenced in that period, then it is available. Okay. Second, if you develop a SEZ park, then also this deduction is available. Third, if you are engaged in generation and distribution of power, then also this deduction is available. Now, how much it is available? It is available for a period of 10 years. 100% deduction for 10 years. But for telecommunication service, it is not 100% for 10 years. For telecommunication service, it is 100% for 5 years and 30% for the next 5 years. It is not 100% for 10 years. Okay. Next, third business. Third deduction, ATIC, is only for two states. It is for the state of Himachal Pradesh and Uttaranchal. Now, what am I supposed to do over here? You are supposed to either start manufacturing over here on or before 31st March 2012, either start, or you need to do substantial expansion in that state. If you are already doing manufacturing in those states, if you are already manufacturing any article or thing in that state, then you have to do substantial expansion. What do I mean by substantial expansion? There has to be increase in plant and machinery by more than 50% of the book value. There has to be increase in plant and machinery by more than 50% of the book value. Then it can be called as what? Substantial expansion. Okay. Deduction will be available for how many years? 10 years. First 5 years 100%, next 5 years 25%, and if you are a company, again it is 30%, just like the first section, that is ATIB. The deduction is exactly like the first section, that is ATIB. Over there also it was same only. Next, ATID is available for certain hotels, convention centers, etc. in certain areas. So if you open a hotel between this period to this period in certain areas, that is between 2007 to 2010, if you open a hotel that is in specified area, at least 2-star hotel, you will get deduction. Or between 2007 to 2010, if you open a convention center like exhibition center, etc., etc., then you will get deduction under this section. Or if you open a hotel in 22 districts which are considered as World Heritage Site by the Government of India. So government has listed down like Agra, like Hyderabad, like certain other states of this country, certain other cities of this country. The government has listed 22 districts which are considered as World Heritage Site. So if you open a hotel between this period to this period, then in the World Heritage Site areas, then you will again get a deduction. How many years I am going to get deduction? Here you are going to get deduction only for 5 years, and here you are going to get deduction as 100% of profits and gains from eligible business will be allowed as deduction. I hope it is clear to all of you. Okay. Next deduction, ATIE, is for certain northeast states like Arunachal Pradesh, Assam, Manipur, Meghalaya, Sikkim, Tripura, Mizoram, and Nagaland. What am I supposed to do over here? You are supposed to go over here and manufacture any article or thing except these products. These products are not allowed. Which are those products? Do not manufacture tobacco or tobacco substitutes. Do not manufacture pan masala. Do not manufacture plastic carry bags. Apart from these three products, you can manufacture any other thing, or you can do substantial expansion over there if you are already manufacturing in these states. If you are already a manufacturer of these states, you can go for a substantial expansion in these states, or you are engaged in any of the business mentioned over here. Like you can open a hotel not below 2-star. You can open a adventure leisure sports like ropeway, cable car, paragliding, etc., etc. You can open over there all these things to attract tourism. You will be getting 100% deductions over here. You can open a nursing home of at least 25 beds, not less than that. Okay. You can open a old age home over there. You can open a vocational training center. You can open an IT center. You can open a manufacturing of hardware center, hardware of IT center. Okay. Okay. Or you can open a biotechnology business over there. If you do these things, you will get 10 years stuck. 10 years, you will get 100% deduction from business and profession. 10 years, 100% profits are what? Exempt over here. You can say rather it is deductible under Chapter 6A. Next one is an extremely important deduction which is available to eligible startups. So this deduction, first of all, eligible startups. This is available to startups who are engaged in innovative startups like Ola, like Oyo Money, like Oyo, like you can say Zomato, like Swiggy. These are startups in India. Okay. So this is available to startups. So now to whom this section is available? First of all, this section is only available to company or LLP, not to other assessees. Secondly, your company or LLP should be incorporated between 1st April 2016 to 1st April 2022. This is extended by Finance Act 2021. Earlier, it was 1st April 2021. It is extended by 1 year by Finance Act 2021 to 1st April 2022. So you should be either a company or LLP, and your company or LLP should be formed between these 6 years, that is 2016 to 2022. Third, your turnover should not exceed 100 crore in any of the financial year. In any of the financial year, turnover should not exceed 100 crore. Fourth, you should hold a valid certificate which is given by Inter-Ministerial Board of Certification that you are an eligible startup. Fifth, your business should be absolutely new. It should not be formed by splitting up or reconstruction of an already existing business. Similar condition was there in 35 AD also. Fifth, sixth, you should not use second-hand plant and machinery. Second-hand plant and machinery should not be used in your business in your eligible startup. In your eligible startup, you are supposed to use absolutely new plant and machinery. But second-hand plant and machinery up to 20% of total value is allowed. Second-hand plant and machinery, if it is imported from outside India and depreciation is not claimed on it, then also it is allowed. Okay. If you satisfy these conditions, then your 100% profits of 3 years are not subject to tax. And how will you select 3 consecutive years? It has to be back-to-back 3 years. And how will you select these back-to-back 3 years? You can select any 3 years out of the first 10 years from the year of incorporation. You can select any 3 years ka block. Any 3 years block can be selected. It can be 1, 2, 3, 2, 3, 4, 3, 4, 5, 4, 5, 6, 5, 6, 6, 7, 6, 7, 8, 7, 8, 9, 8, 9, 10. Any 3 years block can be selected, for which your profits will be what? Deductible under Chapter 6A. Then certain basic conditions, you are supposed to maintain books of accounts, you are supposed to file ROI, etc. That is return of income. Okay. Next section, 80IBA. What does this next section talk about? It talks about certain housing projects. It talks about what? Certain housing project. Now, what is this housing project all about? Pay attention, please. This deduction talks about if a builder is engaged in certain housing project, then we will give deduction of 100% to the builder. Whatever profit the builder will earn, he will get 100% deduction. But the builder has to make a project which is predominantly a residential project. What do I mean by predominantly a residential project? It means there has to be 97% of the carpet area has to be used for residential purpose. Not more than 3% shall be used for commercial purpose. 97% has to be used for residential purpose. 3% or less than 3% can be used for commercial purpose. This is first thing. Second, your project should be approved between 1st June 2016 to 31st March 2022. Again, this is amended by Finance Act 2021. Earlier, it was March 21. Now, it is March 22. So, your project should be approved between 1st June 2016 to 31st March 2022. Third, your project should be completed within 5 years from the date of first approval. Fourth, your project will be considered as completed when the prescribed authority, competent authority will issue what? A certificate of completion. At that time, you can say that my project is completed, and then you have to check, is it completed within 5 years or not? Next, once a house is allotted to a person, suppose a house is allotted to me, then second house should not be allotted to me. Only one house should be allotted to one person. Second house should not be allotted to my wife also. And second house should not be allotted to my minor child also. So these 3 persons are restricted to be allotted the second house. It should not be allotted to assessee. It should not be allotted to the spouse of the assessee. It should not be allotted to the minor child of the assessee. Okay. Next, what should be the size of the land? What should be the height of the building? What should be the size of the flats inside the building? All of them are mentioned by the government. First of all, the size of the land should not be less than 1000 square meter in these 6 metro cities. That is Chennai, Delhi, Kolkata, Mumbai, Bengaluru and Hyderabad. These 6 metro cities, the plot of land should not be less than 1000 square meter. In any other place in this country, the plot of land should not be less than 2000 square meters. Second, what should be the size of the house? The size of the house in metro cities should not be more than 60 square meter, and in other than metro cities should not be more than 90 square meter. Third, utilization of minimum floor area ratio. That is the height. How much should be the height of the building? If the government is allowing you this much height, then in metro city you should achieve at least 90% of that. It should not be less than 90%. If the government is telling you that make a building of 100 meter, then you should make a building of at least 90 meter. That is what this point has to say. Here, in other than metro city, the government is slightly lenient and saying that your height should be at least 80% of what is allowed to you. Okay. Then you have to maintain books of accounts, etc. If all these conditions are satisfied, your 100% deduction of the builder will be allowed to the builder from profits and gains. He has to fulfill all the conditions mentioned over here. All the conditions which are mentioned in the last 2 pages. Okay. Then, if the project is not completed within 5 years, as I have told you, the project has to be completed in 5 years. If the project is not completed in 5 years, then the builder has to reverse the deduction which he has taken in earlier year. It means whatever deduction he has taken in earlier years will be deemed as income of the builder in the current year. I hope it is clear to all of you. Next, your stamp duty value of the property should not be more than 45 lakh rupees. This is an additional condition inserted by Finance Act 2019. The stamp duty value of the property should not exceed 45 lakh rupees. If the stamp duty value of the property exceeds 45 lakh rupees, then this deduction is not available to assessee. Now, Finance Act 2021 has made an amendment whereby they are saying that we are also going to make one more kind of provision like this. That is, now we are going to encourage the builder to make an affordable housing for rental scheme. This benefit which we have learned just now, that was an affordable housing scheme for selling the house. But this new one, this green one, they are saying that the builder now has to make an affordable house according to our specification, our conditions, and then the builder has to let out that house to the people of this country according to our specification. So that is something which is going to come in some time. It has not yet come. When it comes, you have to learn that for your exams. Okay? For November 22, it is not applicable. Next, last but not least, after this section, I am holding this revision video. So it has become quite long. I'll be continuing in the next revision video. I'll try to upload as soon as possible. Don't worry about it. Okay. Last, ATPA. This is available to producer companies. If you are a producer company and if your turnover is less than 100 crore, then this deduction is available to you. 100% deduction will be available for these 5 years. That is 1920 to 2425. Apart from this deduction, you can also enjoy ATC to ATU, other chapter 6 deductions. You can enjoy that. So if you are a producer company, your turnover is less than 100 crore, then you can enjoy deduction under this section. For these 5 years, 100% profits of your certain activities will be exempt. Which are those activities? These are the activities which are exempt. And if you go through these activities very clearly, these are same as those mentioned in ATP. What is ATP? You can go and see ATP, that is Cooperative Society Provision. It is exactly same like that. Marketing of agriculture produce grown by members. Purchase of agriculture produce, seeds, livestock, etc. for supplying to members, or processing of agriculture produce of the members. Okay. So this is what this revision video is all about. So I'm holding this revision now. I will try to upload them as soon as possible. I'm giving my day and night to you all so that I can revise, I can make the revision video at an earlier. But as a human being, it is not possible for me to sit for 12 hours and revise the entire subject. Not possible. It will not be very effective the way it is right now. So if you are enjoying the revision videos, it is helping you all. Please, one request from my side, I'm again making you all, that please share it with your friends. Please make it as viral as possible across your states. Make it very viral in the state of Tamil Nadu. Make it very viral in the state of Karnataka, Kerala, in the state of Andhra Pradesh, Telangana. It is only because of you all. It is only because of your request. It is only because of the love that you have shown on me. I am putting this effort. Believe me, I have not taken any English batch for you all. I will be taking for May 23 and November 23 from 21st of August. There will be a direct tax regular batch for May 23, November 23, full English, a live batch, live online. But I have not taken any batch for November 22. But because you guys are requesting and requesting in bulk, in lot of quantity, not one or two students are requesting. There are hundreds and thousands of students who have messaged me since last so many days that, sir, you are making so good content. You are doing so much for the North Indian students and the western part of this country and the eastern part of this country in Hindi. Sir, please, if you can speak in English, make for us also. So that is the only thing which was felt to me, that this is something which is not correct. I should not do justice to only one part of this country and leave the other part of this country. So that is something which motivated me, which boosted me to make this video for you all. So my request again to you all is, make maximum use of it. Believe me, you follow this revision video religiously and you follow my question bank religiously, you can easily score an exemption in direct tax paper 7. Easily. You have to follow religiously these revision videos. These are very in-depth revision videos. You might realize that there are so many small points I have said in this revision video. You would have not learned also earlier in your classes. You would have not seen also in your book earlier. But these are the points which ICI has tested. To teach CA Final Direct Tax, there need to be some kind of experience. I have been into this industry for the last 10 years. I am teaching CA Final Direct Tax since last 10 years. So I have an experience of each and every attempt which ICI has asked a paper in the last 10 years. I have seen my students appearing for CA Final exams for the last 20 attempts from 2012 to 2022 May. So I know in every attempt what kind of twists and turns ICI is making. So my request to you all is, follow this revision video religiously. See 1 time, 2 time, 3 time, 4 time, 5 time, 10 time, 20 time, as many times as you can see. You can fasten up the video also by 1.5x or 1.75x, whatever you wish to do. You can do that at your end. But see this revision video as many times as you can. That is something which I would like to tell you. So I would like to see your response first. Then only I will continue to upload. If you are not responding me properly, then I am also a human being. I will also be demotivated to upload. I will try to upload at an earlier, but the more positive response I get from you all in the form of comments and sharing of the video lecture, sharing of the revision video, the more I will be motivated. Suppose if the lot of people are commenting below this, sir, it's an a beautiful way to explain the revision videos. It's a beautiful way to revise the DT subject. That encourages me. That will tell me tomorrow morning when I'll get up, no, Aarish, today you have to sit for not 2 hours to revise the subject, but you can sit now 4 hours today. There are thousands of people who are waiting for you. So something, I'm also a human being ultimately. I need encouragement in some or the other. There are a lot of work in my life also. Today is 31st July. There is due date. I have left my work. I have not gone to office. I have told my employee that you do the work. I would like to record this because I have to upload it at an earliest. And now I'll be, after recording this, I'll be going to office. I'll be sitting in the evening and I'll be doing what? The filing of returns, and I'll be observing all those things. So take care, all of you. I hope you all are doing good, and I hope you do great in your exams. Take care, all of you. Bye.